Hello and welcome to the first M&A Bootcamp for 2024. My name is Nicola Corzine and I'm the CEO of the Nasdaq Entrepreneurial Center. If this is your first time joining us, welcome. If you do not know, the Nasdaq Center is a nonprofit that is building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in our chat just momentarily, the center has the honor of providing programs, resources, and mentorship to over 92,000 founders from all over the world, from all industries and all backgrounds. And we encourage you to join us in participating across these programs that are really designed for founder acceleration and success. Now, all of our programs and our support services that we provide are pro bono. They have no costs and no equity components to them. They're built entirely on a pay-it-forward basis, which entrepreneurial ecosystems are fortunate to flourish from. And they're made possible thanks to the generous contributors to this model, who we are deeply appreciative of. To all of our corporate partners and our sponsors, including Nasdaq, Lehigh University, BMO, Airbnb, KPMG, Wilson Sonsini, Microsoft, BPM, and HubSpot. Thank you. We're truly humbled by your contributions and inspired by the support that you bring forward each and every day to entrepreneurs across the globe. Now, before we get started, I'm going to launch just a couple of polls to get us going. First is we always like to slow down and just check in and see how our founders are doing. This is a way that we can prioritize wellness programs for our founders. So right now, we'd like you to take just a moment to check in with yourselves and let us know how you're doing. It's certainly been a long winter, to say the least, and we appreciate that there's a great deal of uncertainty out there right now. To the extent that you can share how you're doing, we know this is going to be reflective across all of your peers that are joining today. So thank you so much for taking a moment just to let us know. Let's go ahead and share those results. Not surprisingly, we always see a healthy dose of optimism showing up for our founders. So that's lovely to see, but also understandably, a number of you who are just hanging in there and surviving. We appreciate that, and we do acknowledge and know that it's been a hard one. Obviously, the topic today that we are here to discuss is M&A. So the next poll that I'm going to launch is just understanding for our panelists who are joining, what side of mergers and acquisitions are you looking to learn about today? This will just help us prioritize a little bit more time on making sure that we're answering as many questions as you may have, and also helping our panelists to really prioritize their time and their insights that they're going to be sharing just momentarily. So thanks for letting us know. All right, let's go ahead and see. We were about evenly blended today. Maybe our sell side's got a little bit more at this point in time, but sort of 55-45. So thank you so much. Okay, so on that night, let's just take a moment and I'll ground us in the agenda for today so that everyone knows where we're going to be. Up first, we're going to be kicking off our program with a market update, which is going to be very insightful and helping to sort of lay the ground for where we're heading. After that, we're going to be going into M&A strategy for early to mid-stage entrepreneurs. We're going to do a quick 5-minute break, and then we have an incredible honor of learning from our AI friends over at Aspen Institute on the criticality of what's prioritizing ethics in AI, and certainly around these conversations. So we'll spend a little bit of time in a fireside chat there. And then we're going to come back with our experts as they share their knowledge on growth through acquisition on the buy-side overview and insights panel. Please note, if you do need to step away, the Zoom link that you use for accessing this part of the webinar is going to work throughout the day today. So thank you so much for using that. All right, so without any further delay, I hope you'll join me in giving a very warm welcome to our first presenter today to share our M&A update, Anthony Cesano, Director of Merger and Acquisitions at BMO Capital Markets. Anthony, over to you, and thank you.
Thank you, Nicola, and good morning, everyone. Thank you to the Nasdaq Entrepreneurial Center for the opportunity to speak with you again today, provide an update from our last boot camp in September. By way of introduction, my name is Anthony Cesano. I am a director in the Mergers and Acquisitions group at BMO, where I focus on technology and business services. Quick background, I've spent 16 years in M&A, including a period of time on the buy side in the private equity world. I'm based in Chicago, and I've been with BMO for about 9 years. Excited to be here today as I'll have a brief overview of the U.S. M&A market with data we've gathered and anecdotes from my experience and conversations with founders, CEOs, and private equity venture capital firms around the industry. Next page, Anna, please. Diving right into it, I wanted to start today's presentation with a little bit of a recap of M&A history. So following the 2008 housing crisis, M&A rose at a fairly steady rate through 2016, then held relatively flat, had a notable down year in 2019. Then along came COVID. First half of 2020 saw a basic shutdown of the M&A market. Then the back half of 2020 was a tremendously busy time in M&A that spilled over into 2021. 21 was extremely busy to the point of diligence providers were unable to take on new projects. Even some law firms refused to take on new mandates just because they didn't have people to be able to do it to the levels that they are accustomed to. All while people were trying to get transactions completed ahead of a possible capital gains tax change in 2022. The first half of 22 maintained a strong M&A market till about early summer when the Fed started the 4 in a row 75 basis point hike, leading to the current environment, which has been rates not seen since 2007. While M&A markets have fallen from their 2021 high, 2023 finished the year a bit lower than anticipated. Overall transaction volumes and values were below 22 final results. Corporate transaction value, however, remained fairly constant from 2022 due to the excess cash on balance sheets and ability to make acquisitions at overall lower multiples than those seen in the recent past. Some of the 2023 results are due to market uncertainty and fewer transactions being introduced into the market in favor of waiting until 2024 to initiate a sale process or a divestiture. Corporates with large piles of cash and private equity firms with reasonable structures in their transactions continue to get deals done. With financing markets tighter than 2021, though, they're available but at higher rates. On the bottom of the page, you'll see that IPOs continue to be a little bit lackluster. They've seemingly stabilized. We expect an optimistic 2024 compared to 2023, although, as you can see, that's kind of a low benchmark following what happened in 2021. Next page, please. Looking at the US M&A market by industry sectors, we have some interesting trends over the last 5 years. Energy materials resources becoming a significant portion of M&A value in 2023, while remaining steady on overall volume or number of transactions in 2023. Technology in the last year has seen notable declines given long-term cash flows being worth less than current treasury rates, which are at highs again seen since 2007. Next page, please. So this page is eye-catching, a lot of data. So we got to caveat a few things before reviewing. And the bars, one of which is the bars are significantly skewed by certain transactions. We have end values under each one of these to understand how many data sets or data points are in each data set. Additionally, as these continue to get updated and reviewed and amended, there is some change that looks back on historical numbers. But the page does give a feel for M&A markets across all sectors. So looking at the US transactions by industry sector and EBITDA multiple offered, we see a pretty steady and consistent increases over the last 3 years across most sectors, with more leverage-heavy industries subdued by rising rates in 2023. Notable sectors to call out: technology finished 2023 strong with an overall increase in revenue multiples, while financial services declined in terms of EV to revenue, coupled to the rising rate environment we find ourselves in. Looking forward, we expect with high interest rate investors will be focused on cash and cash flows. Treasury current yields are a symptom of the current Treasury situation and present attractive returns of 4.5% in context of current inflation figures, which are at 3.1%. Next slide, please. When looking at M&A, it's always important to understand buyers' availability of capital and cost of capital. Funding has been both more scarce and difficult to obtain in recent history. However, dry powder remains elevated, and when full year 2023 figures are released, we assume fundraising will have equaled roughly 2022 with an increase of available dry powder due to fewer transactions being completed in 2023. As we can see, the cost of debt base, or SOFR, has remained in lockstep with Fed fund rates as expected, and generally spreads above SOFR for different ratings of debt remain the same year over year. Next slide, please. So where are we looking for 2024? We expect the Fed to continue to maintain elevated rates for longer, given Chairman Powell's remarks on the matter and expected core inflation. A focus on cash will continue to be Treasury yields at the 2-decade highs, and near-term profits and ability of companies to generate cash becomes a main point of focus, as ability to pay down debt comes at a premium to a high rate environment. Overall, we remain optimistic about 2024. We believe it'll be a soft landing. We continue to see growth in the middle market with a focus on growth by our clients as business as usual. With that, I appreciate the time. Thank you again for all of your time this morning, and back over to you, Nicola.
Anthony, thank you so much. It is good to know that at least we hope for a soft landing. We'll take that one for sure. Appreciate all the
Fingers crossed.
Fingers crossed, exactly. Okay, well, before we jump into our next session, I'm going to launch one more quick poll just to hear our panelists get to know a little bit about you. In the next 3 months, if you could, please let us know how many of you are exploring M&A as an option. Excellent. So we're going to be looking at, fully looking into it. Here to learn. Here to learn seems to be just a little bit higher than fully looking into it, but it is great to see people planning for the future. So very much appreciate that. Let's go ahead and end those results and we'll share those with you. And now let's bring together our incredible panel that we're going to be learning from. And beside today, we've got a great group. Up first, we have David York, Global Strategy Partner at KPMG. Amanda Sigg is joining us, Managing Director, Corporate Advisory at BMO Financial Group. Jackie Hamilton, a partner at Wilson Sonsini, and also Melissa Bradley, serial entrepreneur and managing partner at 1863 Ventures. Thank you all so much for joining us today. Rather than attempt to not do justice to your amazing backgrounds, I'm going to go round robin and just invite you all to share, if you will, a little bit about yourselves and how you are here today joining us. So let's start with you, David.
Hey, thanks, Nicola. Good morning, good afternoon, everybody. I'm David York, and as my picture on the previous slide said, I'm a strategy partner for KPMG in our deal advisory and strategy business. What does that mean? So I spend most of my time working with our corporate clients, helping them with mergers and acquisitions and performance improvement. So thanks for the time today. Look forward to the session.
Absolutely, David. Thanks so much for joining us. Amanda, please, welcome. Over to you.
Thank you. Good morning and afternoon to all of you. Amanda Sigg. I'm a managing director within the corporate advisory group at BMO. We're a national practice focused on providing privately held businesses with a variety of strategic initiatives. Those range from growth, which could be organic or buy-side M&A, all the way over to liquidity options such as corporate balance sheet transactions like a dividend recap or leveraged share repurchase. And then we follow that all the way through to strategic third-party transactions. Happy to be here with you.
Thanks for being here and sharing. Jackie, welcome.
Hey, thanks everyone for joining us. So I'm Jackie Hamilton. I'm an M&A partner in the New York office at Wilson Sonsini, meaning I do M&A all day, every day. I live and breathe it, mainly focusing as a firm on tech and life science deals. Good mix of public and private. I tend to personally lean more toward the sell side, but still do a fair amount of buy side. So excited to be here. Excited to be here with all of you guys.
Fantastic. Thanks, Jackie. And Melissa, welcome. Round us out.
Hi, calling from DC. So I'll say good afternoon, but good morning to my West Coast folks. I'm a serial entrepreneur. I've had the privilege to have 2 exits in my life, one recently. Right now, I'm a professor at Georgetown University McDonough School of Business, and I have the privilege to be a general partner to a family of funds at 1863 Ventures and a friend of the Nasdaq.
Always a dear friend to have back. Melissa, lovely to have you. Thank you. Okay, so let's set the stage a little bit. A recently completed survey that was published by KPMG of 200 really big corporate and private equity M&A decision makers showed that optimism and deal making is going to be a big comeback in 2024. The survey also found that 2/3 are expecting more deal making in 24 than in 23, with most saying that they're hoping to do their first deal in the first half of the year rather than waiting till the end of the year. And over 70% said that they're actively working on a deal now. So all good indications of that soft landing that Anthony was referencing. So David, I want to start with you, not to put you on the spot, but I'm going to. Do you find right now that that's true in your practice? And if so, can you dive into maybe a little bit of what you're seeing this quarter, and maybe to the extent that you can future predict, what are you seeing for the upcoming quarter specific to M&A activity for some of our early and mid-stage entrepreneurs joining us today?
Yeah, no, thanks for the question. So, I think as Anthony's presentation a moment or so ago, I think when the report was written, there was a lot of optimism heading into 24. But I would say that we are still a little bit moribund right in the first quarter. I don't think the deal activity has come to where some of the indicators probably pointed it may do. There's still a little bit of uncertainty, I think, at the macro level, right? So there's still the underlying potential for a spike in interest rates, right, which is causing financing costs to still be high. So I don't think that we have seen the return to volume in Q1 of 24 that we would have hoped. And we, like probably everybody on this call, right, a lot of our business is driven by M&A, right? We obviously really want a buoyant market for a number of reasons. And I'm sure a lot of the folk listening on want some liquidity in the market too. And so, we are optimistic as we head into, kind of the spring and the summer period that, things will come back and things will kind of ungum a little bit. There's still a lot of private equity money sitting on the sidelines. There's still a bunch of people probably underwater from their investments, 2 or 3 years ago that, don't want to realize those losses. So there's lots of things that are, making the market a bit more illiquid than we would like. And as everybody knows on this call, I'm sure, right, typically M&A volumes are suppressed in an election year. So we've got, that fun and games to look forward to in the back half of the year too, right, which I don't think will make things, particularly pleasant. So, I think in general, we would expect 24 to be better than 23. 23 was an extremely low base, so hopefully it can only go up. But it's not going to be, I guess, the big rebound M&A year, perhaps, that we had thought, like it was after.
Yeah. Well, okay, well, let's stay with that theme maybe just for a second. There was another report that came out looking at mastering complex deals and integration from KPMG. And obviously, as you referenced, the last couple of years have been challenging, and they've brought kind of a renewed focus on generating deal value. And this report went on to sort of share that there are fewer deals that are being made in tech and media and telecom companies. And those that are occurring tend to be complex. A very weighted word, to say the least. Can you break that down a little bit? I think, what is it helpful for early to mid-stage companies who are exploring an M&A strategy to understand around that really important analysis that came through in that report, and around the complexity, if you will, of the deals that are getting through?
Yeah, no, thanks. And Anna, thank you for pasting the report into the chat there. So I think, there's a bunch of complexity that the report talks through in terms of, whether it's organizations coming together, go-to-markets coming together, cultural aspects, etc. There's a bunch of things, but maybe just for the purposes of this, I'll just talk about, synergies, which is an area that's kind of close to my heart, right? And obviously in this type of market, buyers are particularly hot, or can be particularly hot on, what are the cost synergies that we need to bake into the transaction, right, in order to realize the value, and where are the revenue synergies potentially going to come from. And I think that's where we see lots of complexity, right? I think, the cost synergy side is a fairly well-trodden path. I think buyers are, pretty pragmatic and pretty knowledgeable about, this is how to size the cost synergy opportunity, right? And this is how we begin to extract value once the deal closes. I think the revenue synergy part, honestly, is still, very uncertain in lots of people's minds, right? And we see, increasing numbers of revenue synergies being, kind of built into transactions. We see earnouts that are tied to achievement of revenue synergies post-close, and the path to realize those, is very challenging, I think, for everybody. It's challenging for the seller, right, on their side. I think it's challenging for the buyer. The go-to-market integration thing makes it very difficult, right? Obviously, as a seller, once you're, newly acquired, you don't have the levers of, Oh, I got muted there for some reason. So yeah, no, I think the complexity that I would look at, Nicola, is on the synergy side, right? And it's, what is the path to realize the cost synergies in a timely way, right? And then how can we decomplexify the revenue synergy?
That's really insightful, and I think gives a lot of people that strategic guidance on where to maybe spend a little bit more time in trying to be ready to answer those types of questions. Thanks for that, David. Amanda, I want to turn to you a little bit. As has been shared, nothing in entrepreneurship is ever in isolation. So as we think about sort of what is happening around the market dynamics right now in IPOs, PE, and VC, can you walk us through maybe a little bit of how you think, well, how it is affecting the M&A market, and certainly what bright spots, if any, hopefully you do see out there?
Sure, thank you. Well, it's certainly been an interesting time in the market given the rate environment, geopolitical instability, and recessionary concerns. That soft landing is at the top of everyone's mind. What I do see as being bright, all that said, is strong fundamentals, diversification, scale, and profitability still lead to investment. So most privately held businesses that we work with today might not have all of those components to approach an IPO market right now. And so instead, they might be looking to private capital to assist with some of those strategic growth initiatives and perhaps buy additional market share or diversification that will help the company in the long run for a more strategic exit plan. In those instances, some of the companies are working toward lowering their volatility, which helps expand the valuation upon an exit. And in the meantime, hope to see interest rates stabilize or perhaps decline, as we're all hoping. So I'm cautiously optimistic that 2024 will see an uptick in some activity across the board. However, we have so many unknowns at the time that with the upcoming presidential election, geopolitical and unforeseen shocks to the system, I'm hopeful that there's a balance of activity to kind of bridge us from the beginning of this year going into next year.
Cautious optimism definitely seems to be the name of the game right now. Now, obviously, you also work with corporates on the buy side. Let's take maybe a moment there and invite your thoughts on what are you actually seeing from your corporate clients who are thinking about in terms of M&A in the market right now?
Yeah, there's certainly a lot of interest with regard to buy side. I think, again, just there is capital out there to be deployed. It's all about discipline and making sure that if it's not an all cash use of balance sheet, that, the funding and the dry powder that Anthony talked about earlier is there. So while there's a lot of interest, again, the volume's not really there yet. Where there is interest, it's taking longer to get deals across the finish line. And there's various factors driving that. Certainly the uncertainty in the market, it makes the synergy point that David talked about very difficult to ascertain, which leads into the price differential. Now, we found that there's some COVID and the liquidity pumped into the system, the pent-up demand from the COVID downturns and supply chain disruptions ended up with the most recent, 18 to 24 month period being some of the most profitable years for some businesses. And so then there becomes this gap between buy and sell price that we've seen in the market. And so as a result, when you have rates being very high, the financing structure is really critical to kind of getting those deals across the finish line. And as such, one of the things that we've been talking to our clients a lot about is exploring financial structures such as earnouts or seller notes to make up some of the differential in price in the meantime until the gap gets a little bit more narrow.
That's really, really insightful to have that knowledge on. Thank you. Thank you, Amanda.
You're welcome.
All right, Jackie, let's talk about one of an entrepreneur's favorite subjects in the whole wide world, regulation. No, I'm kidding. But on the company side, obviously, it's been really interesting to watch. We've seen regulators, especially in the UK and the EU, block acquisitions. Figma by Adobe took 15 months longer to kind of see this path towards regulatory approval. What should some of our smaller companies be thinking about in terms of regulation and its effects? And obviously, I would presume there's some variance by industry, but any insights you can offer over that?
Yeah, no, absolutely. And so there are obviously various regulatory regimes. So I'm just going to say, I'm not going to talk about everything. So foreign investment, data privacy, you can use regulatory to mean everything. I'm going to focus on antitrust since that's kind of become an even more significant part of the M&A market in the past several years. So I guess I'll start with some good news, right? So smaller companies are often, maybe often is too much, but I'll use often, sort of off the hook here based on deal size. So the current HSR, and this is in the United States, reportability threshold is just under 120 million. So it's like 119.5. And so if a deal is not reportable, if you don't have to tell the regulators that you're doing something, you're a lot less likely to have a review. Not always, though, right? So even when a deal is not reportable, there's instances where, a small company is being acquired by a large strategic, or we've recently seen this be the case with, private equity acquisitions as well. They have a target on their back. And so you need to think about reviewing that antitrust risk, making sure that the merger agreement provides adequate protection. So typically you're doing, let's say, a $50 million deal. You're not thinking about antitrust risk. That's not necessarily built into the merger agreement or purchase agreement. Yeah, so I mean, I think it's something that somebody, getting sophisticated counsel. I'll put in a plug here for our awesome world-class antitrust team. We do this all the time. And I'll give you just a couple examples of these sort of smaller companies, or companies that are things that you might not think of as automatically getting these types of reviews. So there's a Sanofi deal. They were buying a company that was a pre-phase 2 company, had no revenues. It solved it was treatment for Pompe disease. The FTC had not taken action in a pre-phase 2 deal up until this point. So I think people were really surprised by that, right? So you're talking about something that's totally speculative, very early on, hard to see how there's a monopoly. But I think you end up in situations like that with the current FTC regime. Yeah.
Really interesting. Great insight on that. Now, obviously, as you shared, you are living and breathing this each and every day. Is there any insights that you can offer for our founders joining today on sort of where you're seeing deals maybe getting stalled, or just, things to watch out for? If you could give advice on ways to not have the probability length of time extended, when obviously everyone's trying to get the deal done as quickly and efficiently as possible.
Yeah. So I think we often see deals get stalled where there's a multi-jurisdictional review, right? So if you're reporting in the US and also China or also the EU, so Microsoft Activision obviously had various jurisdictions looking at it, for instance, and that's part of what took so long. Ultimately, it kind of comes down to the regulators, obviously being very responsive, getting really good advice on the front end, making sure that the documents kind of protect you. And I realize now that I actually didn't answer a question earlier about the industries where this is going to, you're more likely to get scrutiny. So obviously tech and AI in particular, and life sciences, right? So those are the things that the FTC has been really focused on. 2024 is obviously an election year. It'll be very interesting to see what the FTC does. But I don't think there's any signs of stopping. I think they are very focused on competition.
Yeah. Okay. Well, thank you for that. All right, Melissa. First of all, congratulations on getting the deal done recently. That is fantastic. You just closed out on that recent sale. This is your second exit, though. So I want to invite you to sort of maybe share a little bit from that founder vantage point. What was the experience like going through in today's market dynamics? And to the extent that you can, how is this different, perhaps, than what you've observed both on the investor front and then directly yourself in years past?
Yeah, so I accept the congratulations, but it was probably one of the most stressful moments in my life. And I think now being a GP, my empathy continues to increase for other founders. I think a few things come to mind. One is that we were fortunate enough to have 2 potential acquirers, and did not get into a bidding war, because what was interesting is they both had very unique perspectives and saw the future of the company differently. And so I think it's important, as you look at these deals, what do you want the future of the company to be? And in our case, I'll be honest, there were 3 founders and we were all split. We didn't all agree where we wanted it to go. So I think first and foremost, being really clear, if it's you, your board, or other founders or other earlier investors, like, where do you want this to go, and what do you think an exit looks like? I think too often when we go through those pitch meetings, like, what are your exit? And you just be throwing stuff. But as you watch the markets evolve and mature, you really need to have that into consideration. I think the second thing is valuation was a really big deal for us. The desire for us to sell was, do we go out and raise more money and risk a down round, or do we look at more of a strategic opportunity to grow the business? Because we were mindful of A, the pressure from our existing investors, and B, because it was a B2C business, but it was a tech platform, post-COVID, we were really struggling to manage our CAC because it was just harder to get people's eyeballs and attention. And I would say because of COVID, we delayed the release of our pricing. So we had said we would do a free and then we would release, and we were like, well, after COVID, what business owner is going to pay because they don't have it? So there were some dynamics that we had to be really clear of being able to defend in that potential pricing, and to share why we did it and what would have been different, and how does that now impact the original trajectory of the business. I think that the other piece that was interesting is negotiating our other investors. Our investors were split in terms of which way they wanted to go. We had some who were like, hey, go for it. This may not be ideal in terms of what my short term, but if this is really where this new owner is going to take it, that's great. And I think for better or for worse, because of the markets right after COVID, they opted to go with something that was much more certain in cash flow with both cash and stock swap versus what would have been a 3-year opportunity. And again, I can say we didn't all agree. We all signed and we came to consensus, but we didn't all agree. And so I think just really being thoughtful around when that acquisition happens, understanding A, what do you want your role to be? B, what do you want the investor's role to be, and how do you want them to walk away feeling? And 3, what's really important to you as a founder, and what are you willing to fight for? I think if you fast forward now to these markets, in our portfolio, we've actually also had an exit. And I would say it was very much around valuation, understanding, do we take a potential short term down versus a hope and a prayer for something longer term, because the markets, particularly around, I would say, businesses that are focused on smaller communities like people of color or run by founders of color, just don't have the same perceived value. I think today, as we're negotiating a couple other folks to be acquired, we are mindful less and probably focus less, not necessarily a good thing, on what our immediate goal is, but will we achieve the impact, and can we, from a portfolio construction perspective, delay the receipt of those potential upside returns. So I think all in all, the whole thing is a balancing act of balancing your personal and emotional perspective versus the financial desires of yourself and your investors. And I think being able to think beyond the moment, but also being clear, what is your negotiating power? We had amazing statistics. We had all of our comps done. And I think that saved us in the end, that we could really talk about user time and efficiency and kind of the scores and all those kinds of things. We had that, right? Our customers were extremely happy. And so I think really understanding what is the value beyond yourself and the technology, what is the value of the customer base, how many people will transition. And the last thing I'll say is be clear what you want your role to be. I was clear that because of the way it went, I stepped back, but other employees also stepped back. And so I think being really clear and having those conversations as you enter this, I think we probably may want to have shared with our employees a little bit sooner we were going through this, so that people didn't feel like, wait, I got 3 months to make a decision. I think really be clear about who do you bring along, how much information do you share, and what are the non-financial assets that are going to be critical when that transition happens.
I really appreciate sort of addressing a lot of the psychological and emotional side of the transaction, because obviously it is perhaps one of the most intense emotional roller coasters, dare I say it, that any founder and any team is likely to go through. You've already given a lot of nuggets, but I'm still going to ask this question. Obviously, a lot of entrepreneurs, for a variety of reasons, have to explore M&A today. If you could give them sort of a salient piece of advice in this market, what do you want them to know beyond what you've already shared, Melissa?
So I think we're actually, there's a company now that we're not investing, we're advising, who's trying to go through this. I think one is understand that there's a cost to it. The number of trips and travel and all-day meetings, there were both financial and staff-related costs to pursuing this. And in our case, we had 2 different people. So I think that's something that I think a lot of people don't prepare for, right? Particularly if you start to think of an M&A when you're maybe only 3 to 6 months of cash flow, you could easily spend a month and a half just going back and forth. So I think timing and the financial resources to really consider an M&A, make sure you have enough there. I think the second thing is, again, be careful what you're going to stand for. When you think about the cap table, figure out what can you do and say to your investors so that if the purchase price is not what you want, that you think about what are the other ways to provide them upside, right? Is it a stock swap? Is it some slightly elongated payment plan whereby as the price increases, then they can, kind of have a shareholder buyback, but spread over a period of time. I think we were very much feeling the pressure to solve that in the moment. And if we had had a little bit more time, we might have thought of, hey, we may go to a different deal and you all will get paid back in a shorter period of time, but you're probably not going to have the same multiple. And I think the final thing, which is evident by this group, have an amazing legal and accounting team, because when you start to really argue and fight about the valuation, you need your accounting firm, and ours was amazing, but you need your accounting firm to be with you in lockstep. And I think to make sure that from a legal perspective, in this case, we ended up getting a different lawyer, that you have a lawyer who can both represent you and help you, because you're battling sometimes two sides. You need to have them represent you against the acquirer, and sometimes you against your investors when you don't agree. And we're all friends and everybody gets along, but when it comes down to dollar and cents, people's perspectives change. So I think making sure that you have a sound source and resource, a trusted resource that you can be brutally honest with, and they will give you a reality check, because otherwise, you as the founder will be the ping pong between the two sides that you have to battle. And I think personally, I will say that was underestimated on my side.
Such good insights, And obviously we highly advocate for that trusted board and having them around you as you're going through this, just to be able to, have a safe place where you can ask some of these questions and sort of workshop and talk through a lot of the challenging decisions that you're making in those real-time moments. We are going to be opening up for a live Q&A in about 15 minutes. So friends, as you're listening to these incredible insights from our panel today, please feel free to drop those questions into that live Q&A function, and we'll try to get to just as many as we can. But for now, I've got a few that I want to kind of go round robin on, if you will, because the variance of just expertise that's represented here, I want to go a little bit deeper on. So let's start from each of your disciplines, really looking at your recommendation for evaluating M&A opportunities for early to mid-stage founders and companies. How does one do well when it comes to the actual overall evaluation of it? So Amanda, maybe I'll start with you, banking side, and obviously you also are representing corporates on the buy side. How would you answer that question? What would you recommend for people entering into this, thinking about the evaluation side of mergers and acquisitions?
Sure. Well, there's certainly a lot that's really practical in that situation, but I would say what comes top to mind to me is acumen around the financial diligence, particularly given some of the dynamics that we talked about value expectations and bridging any gaps. So one of the things, whether you're a buyer or a seller, would be recommending a quality of earnings report, just to level set. It helps set expectations for what you might receive as a seller versus what someone's going to pay as a buyer. It may be avoiding some surprises there. And in addition to that, if you're thinking about being on the buy side and you're looking to acquire, having that financial diligence to help you identify, again, those synergies and things that are very critical to making the process an overall success. So with the strong, practice around, that financial diligence and identifying synergies, it's really critical at the board level, management level, sellers level, to understand what that rate of return on that investment is and the long-term value creation. So as I'm talking to, potential sellers, thinking about, what's the right number, and then how do we bridge to that, versus if you're the buyer, saying what is your real rate of return against other opportunity costs and other investments that can be made in this type of market, particularly in light of some of the unforeseen items that we've talked about that could be coming yet this year. Is there going to be a soft landing? So how do I make the most out of this return on this investment, and ensuring that I have a real sound framework around the implementation side, because that's really the only way you get to achieve your synergies.
Great insight. Jackie, let's flip over on the legal side. What are some of the insights that you'd have for the evaluation for founders when they're looking at M&A deals from your perspective, from your side?
Sure. Yeah, no, absolutely. So I think it's I think the financial points are probably the key. And just kind of going off of that, I would say look at more than just the purchase price. Right. So that's a high line thing. And obviously that looks good to a lot of people, but you got to get into the details of, is that cash? Is that stock? What kind of stock is it? Is it common stock, preferred stock? I know that sounds really basic. What's the valuation of it? But that is the question that often you see people, especially first time folks, they're like, well, they said they're going to pay me X dollars, but like, what actually is X dollars mean? Any required rollover, right? So do you get to keep it all up front? Or are you, as the, particularly the management team, do they need to come along for the ride? Significant purchase price adjustments. So it sounds great, but actually we're going to deduct a bunch of stuff. Deferred revenue, for instance, often comes up. Indemnification holdbacks. That's probably a little bit, too legal, if you will. But I would say bring in legal counsel even for a quick review. And then, whether those amounts are all up front, right? So not just the rollover, but are we talking about it's a total price of, 20 million now, but it's like milestone payments and you could get up to 100 million, or is it 100 million up front? Like what are the numbers? Because that obviously 20 million versus 100 million, those are very different numbers, right? And this does come up often. So I think kind of digging into the details, obviously price is important, but what that actually looks like, I think is really key.
I'm glad you brought up milestones. We often get faced with a lot of questions from founders around this issue of sort of like, okay, should I expect that everything's going to go well and I'm going to hit that number, or is there sort of some checks and balances that can be put into place where, everybody's got the same vested interest in trying to achieve that top line number? What are, not to go off script for a second, but what are you seeing in this market right now, maybe around milestone payouts? And then second, any advice you'd offer for our early founders who, are tackling that issue for the first time and trying to figure out, well, should I expect that that's really going to happen or not?
Oh, no, it's a great question. And I was going to hit on this later, but so I think you see a lot more milestones because one of the things in tech, and I think this was mentioned earlier, is that you're still dealing with buyers and sellers who are kind of level setting on valuations, right? So buyers are like, I want to pay you X, and sellers are, I want 2X, right? And so how do you level set those things? And often we're getting closer, but the way to kind of bridge that gap often is an earn-out or a milestone. And so, yes, I think we see them even more. They're very, very common in life science and med device deals. They were probably less common in tech deals, but I think there's been an uptick. And so I think there are ways to protect yourself on the sell side. So you want to make sure that you're negotiating, a whole set of covenants, right? So obvious one, if it's tied to something that you as like the CEO, for instance, have to go do, like you are part of the thing going over, they shouldn't be able to fire you without cause, because otherwise they could, and then you just don't get the earn out, right? So that's like a very basic one. But there's all sorts of, what is the buyer going to do? Are they going to put money into the marketing? Are they going to keep going with the strategy? Do you have the ability to control the strategy? Are you essentially going to be a subsidiary that's just sitting there with full autonomy? Or are you going to answer to all sorts of people? Is it about sales? What do those sales look like? How are you valuing them? There's a whole lot to go into them. And so if that comes up, particularly at the LOI stage, I think it's worth trying to negotiate. I'll say this later too, but the most negotiating power sellers have is at the LOI stage. Once you sign it and you're under exclusivity, you're in for it, and you're probably going to lose some of the battles that you might have won at the LOI stage. So.
A key takeaway, friends, for those of you listening, pre-LOI, not post. David, I'm going to flip over to you, invite you from the advisory side. Thank you so much, Jackie. That was gold. Can you share a little bit about sort of what you're seeing and how you advocate founders to sort of think through the evaluation side of the house on your side?
Yeah, no, I will. Thanks. And maybe just to build on Jackie's point, which I thought was a really good one, and I mentioned it at the start, I guess I've seen more issues with milestone, those kind of agreements. They typically go worse than everybody expects on both sides. I just think they are very difficult to negotiate. And obviously once the rubber hits the road, as you say, there's a bunch of reasons why people can't achieve their earn-out targets. Some of their own volition, some not. I think it's a very, very tricky thing for buyers and sellers to get right. And again, I've seen it go wrong more times than right. But just a couple of other things to build on from a evaluation perspective. Two things I want to mention. So one is, I just think this kind of regular review of M&A strategy should be part of a kind of normal course of business. I think if you're only doing it as a result of some kind of event or action or outreach, you're probably missing the optimal time window. So I think it's like you need to be ready. I think Melissa made a really good point in her comments earlier. You want to be ready and you want to take advantage of opportunities when they come. And part of that is just a regular review of, hey, what is our exit strategy, right? And what do we think about M&A? I mean, that's what the corporate buyers are always doing that, right? And if you look at opportunistic PE buyers, they're also regularly doing that. It's like hey, once the stock price reaches X, we might consider some kind of take private event. So I think building it into your kind of normal course of business is important. The other thing, and again, Melissa mentioned this also, which I thought was great, was just being sure that you really understand the investment thesis, right, from the buyer's perspective. I think I see a lot of times where there's a gap or a mismatch between why the buyer is looking to make an investment versus what the seller is trying to show or evidence in what they're creating. And I think if you take a step back and put yourself in the buyer's shoes, it'd be like hey, why am I valuable? Like why are they looking to make this investment? And then it makes diligence, etc., much easier, right? Because you can then tailor your messaging and you can tailor your artifacts, etc., to help support the investment thesis, because that's really what the buyer is trying to do through diligence, right? So diligence is broad, a lot of it is confirmatory in nature, but what they're really testing is, can I prove out my investment thesis? And if you understand the investment thesis, it just makes the diligence process much easier.
That's everyone on that same page, which is always good. Thanks, David. Melissa, David set you up really nicely, already identifying several of your great points that you made earlier. But, from the founder perspective, obviously, he's already said, don't have it be the surprise inbound inquiry that gets you thinking about exit strategy. But what else would you say is really important in sort of really evaluating M&A at that founder level?
I think one is, are you ready? Are you ready from a cost perspective? Are your books ready? Are your legal documents up to date? Do you have all the nightmare that you live through when you get the money? It's like 10x where you're about to be acquired. So I think really making sure you are ready in terms of organization and ready emotionally to really just be digging in and many times have to defend the decisions that you made. And because we had successfully made out of COVID, there were a lot of decisions that we would not have made if not for. And so that was interesting. I think the second thing is really being clear. What are your goals? Are they financial? Are they non-financial? Is it more important that you're involved, that you're not involved? Is it more important that the mission continues? Think about your customers, all those kinds of things. Particularly, I think many founders go on to do something else. And so, what is it what is it you're going to leave? What is the reputation? What is the signal effect that you're sending about your business, about the market, about yourself? I think that's important. I think the other piece is do your diligence. One of the things we always tell our founders is people do diligence on you, do it on them. And so we spent a lot of time diligencing each of the potential acquirers. We didn't always compare notes, but we kind of divided and conquered. And I think each of us, based on our diligence, felt a certain way about the person. So I think really spend time doing that and having a sense of, it gave us a sense of what was going to happen in the negotiations, how long they were going to be, how hard they were going to be by just talking to other people. And I think the final thing is if you have a co-founder or somebody else who's in a senior leadership role, make sure you're in sync and also have a plan when you're not in sync. We were really fortunate that while it was not acrimonious, but we didn't agree that we had legal documents amongst us all in terms of how to make these kinds of decisions. And so I think a preemptive measure is to David's point, is to be proactive and have these conversations with key people on your team, whereby you have a process to make a decision relatively quickly so that it doesn't tank the deal of what do you do in the event that you don't agree? What do you do in the event that you don't get the things that you want? What's most important? Because I think we were luckily given the time to have those discussions, but we probably could have escalated and accelerated the process if we had had those discussions before we really dived in and decided, yeah, we're actually going to sell this company.
Really, really key insights. Really having that thoughtful indication of where are we aligned, and if we're not aligned, how far apart are we, and are those break or no break decisions? Those are really helpful. Okay, so we've all got the evaluation down. Now I'm going to flip it on the head and say we're going to enter into a deal. This is great. This is very exciting. It's going to be a soft landing. what would you recommend for each of us as we think about preparing and getting this deal done? And again, with that drive towards hopefully efficiency as much as possible. Amanda, let's start with the banking perspective. What do you recommend for founders really thinking about preparing and getting the deal across the line in this market?
Yeah, thank you. I'm going to piggyback off of Melissa's prior comments and some of what David said. I think they covered the sell side really, really well. So I'm going to focus a little bit more on buy side here. So a lot of my conversations around building a successful framework for my clients is they've already determined that M&A is the best avenue to achieve their growth for various reasons. And so that means they've talked about the investment thesis, such as who they're looking to acquire or why you're looking to do it or what the strategic benefit is going to be. So that's saying that they've already kind of built that into a regular point of making, being able to evaluate it. I think that David and Melissa both touched on. So we're going to assume that that's happened. But in this environment, and to make sure that approaching each deal is the best use of time and capital, we often spend a time having a plan to saying, designate who's going to drive the M&A strategy and integration, establish a sourcing plan, which is not always that easy to do, establishing a due diligence checklist and sticking to it, meaning don't fall in love with the deal just because it's a deal that's there. So being very disciplined around, the parameters that made it a good investment thesis. And last but certainly not least, from a banking perspective, make sure that you're talking to your banking partners and have identified that you actually have the dry capital to achieve this strategy. So what's the maximum leverage point? What's the cash flow sensitivities? Is there a portion of debt and cash being used, or do we need an alternate source such as private capital to help fill in any gaps?
Excellent. Thanks, Amanda. It's hard not to fall in love sometimes, but we get that. We absolutely understand. Very, very good advice. Jackie, over to you. What do you recommend on the legal side?
Yeah, so I think a lot of people have hit on this, but I think, and I know Melissa stressed this a lot, but I think number one point is particularly the sell side, thinking about getting organized really early. So I say 12 to 24 months. So I know David mentioned, look, this should be a routine conversation. But people often think about this in terms of an IPO, right? Because there's so many things you have to do leading up to an IPO, but they don't think about it in M&A. It's much more reactionary. I try really hard to get in front of boards and say, look, you're thinking about an IPO, maybe it's going to be an M&A deal. Maybe that's a better option. So I think getting organized, because in the event that you do end up with a deal, and inevitably, hopefully you will, even the best companies, they're great. If they are unorganized and things just look crazy, like the cap tables everywhere, it's not going to lead to great places. No one's going to pay you more because you are unorganized. They might pay you less though. And then again, I think negotiating more than the price at the LOI stage, particularly if you're going to be locked into any sort of an exclusivity period, make sure that I hit on this before, but I think that's a really important point. So those are my big ones. And then I think, again, to just piggyback off of what Melissa said, is figure out what your deal breakers are, and talk about those internally. If you have investors, with your investors and with your legal counsel, right? So there are things that your lawyers, because we're lawyers, we're going to push. We think that they're important. If they are not important, let us know. Let's figure out what the 5 to 10 biggest things are, because what happens is we negotiate everything else, and then those things still exist, and then are you going to get railroaded or are you not? Are you going to say yes, or are you actually going to walk away from the deal? So if you know that early on, I think it puts you in a much better negotiating position, and it's much more efficient for everyone.
Yeah, really good counsel. David, anything you'd add on the advisory side for getting this deal done?
Yeah, so just quickly, I think a couple of the panelists have mentioned being organized, and I've done this panel 4 or 5 times now, and I always talk about organization, so I won't beat that horse today. But I think in this market, more importantly, be really patient, right? Recognize that deals are going to take much longer to complete than you think, right? The process will be extremely onerous. So I think patience is important. Trying not to get frustrated with the traction or lack thereof, I think, is important. And I think the other thing to think about is just keeping the underlying business still performing. What we've seen is a lot of founders or CEOs kind of take their eye off the ball because they get distracted by the M&A process. In this market, it takes a lot of energy to keep top line growing, right, and to keep costs manageable. And I just think, don't get distracted by, what's going on, or try not to get distracted, and make sure the, underlying performance of the business continues to be strong. Because again, once we move into, potential synergies, etc., or earnouts, you'll need that, strong kind of exit velocity as you go under new ownership. And I think it's an area where, again, we see a lot of, softness. Deal processes take longer. The underlying business starts to weaken, right? It then puts pressure on valuations, et cetera, et cetera. So, I think just kind of keeping your eye on, making sure that you're running your core business is important.
That's really critical. Obviously, we don't want to give anyone any reasons to sort of have renegotiation options to go down, or lack of excitement and energy at the last mile. And then equally, I think too, managing the expectations as to the time and the challenges involved, and making sure you have that support system around you, both with your deal team, like great experts represented here on the call, but also with another founder maybe that has been through this, or an investor friendly outside observer that you can talk to, and just vent, because sometimes I'm sure our founders just need to vent, but making sure it doesn't distract from the business growth, and doesn't also distract from the criticality of the deal, and the signaling that's happening to employees around this moment in time is really important too. So Melissa, maybe I'll invite you to sort of round us out on those perspectives, tips and tricks for getting the deal done. What were some of the things that really mattered in reflection on this last one?
I'm just gonna offer one piece, because I think my fellow panelists have nailed it, is check in with yourself. Being an entrepreneur, being a founder is hard. It's stressful. The economic environment is stressful. The electoral environment is stressful. Maybe I'm biased because I'm in DC, but I think all of us, when we kind of did our postmortem, none of us recognized the emotional wear and tear of selling the business. Something we had worked really hard for, we had sacrificed for, we had put a lot of our own money into. And so I think just be prepared to really figure out, what are you going to do to balance those really hard conversations? We finally, very small thing, but we were flying back and forth to meet with the potential acquirers. We would sit in literally one room all day, and then we'd go to dinner. And finally I was like, we gotta stop going to dinner with them. Like, it's just too much. Like, we never get a chance to turn it off. And so I think just really figure out, what are your opportunity costs personally and professionally and financially, and just make sure that you stay strong, you stay stable, you stay mentally engaged, because I've seen founders who just get worn down by the process and just throw their hands up, because you are managing so many moving pieces and so many different perspectives, that you've got to just make sure you're taking time to remain personally and emotionally balanced.
So important. Thank you, Melissa. Thanks for addressing that, and thanks for that confidence and insight. Okay, so I'm not going to finish our last round robin on asking any of you to have that perfect crystal ball for 2024, but what I am going to ask you instead is, what do you think are the factors that inform your outlook most importantly each and every day, or with colleagues and around you? And then what information sources maybe do you trust when it comes to sort of thinking about the M&A market at large? So let's, Amanda, Jackie, David, Melissa, just invite you to sort of share, like, who do you turn to? Who do you trust? What are the factors? We've talked about the political and obviously geopolitical environments right now. But what else makes up the composition when we think about the outlook for M&A this year? Amanda, shall I kick it to you to start?
Sure. Well, I was going to share, and it's kind of a key takeaway, but being patient in this market, given all of the uncertainties, I would say, I have the benefit of working for BMO, and we have our economists out there, but I always, subscribe to the Wall Street Journal, read my own, but, panel and poll the economists out there. Certainly there's sector specific items to pay a lot of attention to, particularly in a, political year where we could have some changes later in the year. So, I think just being patient and diligence is really important. And again, coming from the banking side, going back to the patience and diligence around having a plan that you can execute, make sure that all of your partners know where you're at in that process, so that we're willing to step up and help if the right deal or something presents itself that is very opportunistic, to not be unprepared when that hits your table.
Great. Very good. Jackie, David, Melissa, any tips, tricks, places you turn to for M&A considerations? What shows up?
I mean, I think similar to what Amanda said, we have folks internally who do a lot of market analysis, and we subscribe to all sorts of stuff. I like the Wall Street Journal. I think it's great. I think the New York Times is helpful in certain ways. I think just keeping up to speed on what's going on, right? So we focus on tech and life sciences. Those are things that it's not some niche community out there. It is like every day. That's what I love about it. Is you talk about like the iPhone, like now that's in everyone's hands, right? And so thinking about what's going on in tech, I listen to a lot of tech podcasts. I listen to Pivot a bunch. I also, and I think I'm probably the only person on this call that does this, but I'll read merger agreements, publicly filed merger agreements for fun, to just sort of see, maybe not the whole thing, but to see what's going on, to see where things are headed. So I think there's a good way to stay up on what's going on in the tech market.
That's a great tip, though. I mean, I think we often talk on the venture side, like it's helpful to look at an analogous deal that inspired you and then sort of reverse engineer and understand the construct that made it happen. No reason not to apply the same logic potentially on the M&A side. In fact, maybe we all should. So that's great insight.
Absolutely.
David, I saw you come off mute. You got some good sources or intel. Obviously, KPMG reports, like we dropped mics earlier today. We got to hit those up and other reports.
Yeah, no, of course. I don't read publicly filed mergers agreements, unfortunately, but it sounds interesting, Jackie. Maybe I'll get into that. But I mean, I read the FT, so I'm probably too British to read the Wall Street Journal or to trust it. But I read the FT, and then I guess in terms of a kind of leading indicator, and Amanda gave a good plug, right? So KPMG, we have a very big financial diligence practice. Often, the creation of some kind of carve-out financials, right, or a QOV report, is a very early step in M&A activity. And so I guess I use that as my internal signal for, are we going to be busier, right, on M&A activity? And, at the moment we see a bunch of sell-side preparedness, right? People getting ready to do those kind of carve-out sell-side activities, which hopefully is a precursor to a bunch of buy-side stuff down the road. So I guess that's my kind of internal barometer of it.
Nice. Very nice. Thank you.
I'll keep it quick. I have the 3 Ps. There's people, there's publications, and there's policy. So I think all the publications have been well named and sourced and tons of databases. But at the end of the day, nobody ever really signals they're looking to buy a company or they're looking to sell a company. So just really having a wide a swath of folks who are friends and in the space. We always talk to investors who didn't invest in us. We talk to entrepreneurs. We talk to people in large companies. We were very clear what we thought our exit strategy would be. Always willing to take a call when people start saying, hey, let me hear what you guys are doing over there. So I think that really informed and having a friend or a friend call and say, hey, they're doing something similar, literally kickstarted these conversations around acquisition that I think they were like, I'm not why you take that call. And I was like, you just never know. So I think just really keeping in touch with people. And then I would say policy, right? I mean, again, the financial opportunity cost of watching interest rates and how much money is still with dry powder and what are companies' gaps and can you fill it? We've seen quite a few acquisitions in the CPG space. We've seen Mael be acquired by P&G. We've seen a private equity firm take over Honeypot. And so I just really making sure that you're clear what are the big P policies legislated from a financial markets perspective, small P policies, and where are companies trying to go and fill market gaps they don't have. Where can that be useful to you and your decisions, and who may be actually picking up the phone to call you?
Really good. Really good. All right. Well, we've had some great questions that our audience has been dropping into Q&A. So I'm going to try to get through as many as we can in the next handful of minutes. I want to start by an intriguing one. And again, it's one that comes up more often than not. How do you think about valuing human and intellectual capital that is being assigned over in a deal, and often obviously is not showing up, quote unquote, in the traditional accounting reports? Once upon a time there was the great old, like, how much is a quote unquote engineer or insert talent worth as it moves over? But what has gone in and what has made sense when you're on the decision making table around the value of the people that are actually making this possible at the end of the day? I don't know who wants to take that. Melissa, I see you nodding, so dare I put this one on you?
Yeah, I mean, I'll start. I think when we were having these conversations, we were clear at the outset with both of them that the entire team would not go. And at that point, when we saw that we were getting close, potentially with both of them, we basically did 2 things. We did an internal audit amongst the co-founders, say what were the critical pieces based on each potential acquirer's needs and desires, so that it would be a good exchange, positive upside for everybody. And they weren't the same people. which was fascinating. And so then we met with team and let them know. We would have weekly meetings, say, this is what's happening and this is how it's transpiring. To both potential acquirers, we were very clear, this is the track you're on. Once we realized there was a relative blend of thesis and we understood what their long-term plans, we put together staffing charts, said, this is what we recommend. You can decide, but these are the people. And I think you should look at them irrespective of cost. We found that one was willing to do that and one was laser focused on cost. And we were very clear, if you go that path, this is what's going to happen. But I think you have to really be clear and know what's happening with your team, to know it's never just one person. It's usually their support team as well. And then be really honest about what those costs are. What are the financial and non-financial costs? So we needed to go back and look at our employee records and what people had asked for and who we knew. There were a couple of people we knew were about to have babies, and so that they didn't get screwed respectfully in this process. So I think being just very vocal, having a roster literally of what needs to happen and being prepared. I don't know that we took a hard stance. We were pretty clear. If you're trying to accomplish this, if you don't do it without these people, it's not going to happen. And I think amongst the co-founders, really figuring out who was going to step back. And I was pretty clear early on, I'm willing to step back. And I think that was important too, because otherwise the three of us together were very top heavy and very financial heavy. And we were very clear what were the pros and cons as who peeled off and who remained. And so I think that's first an internal conversation, then a very probably hard, but forward conversation that has to happen. Otherwise, I think you run the risk of folks coming back and say, you didn't tell me this was going to happen when these people left. And I think from the technology perspective, we had already had a third party value that. And so that was really less of a discussion because, again, to everybody else's comments, we had done our homework and were regularly on top of what we thought the technology was worth based on comparative metrics, user profiles, et cetera.
Right. David.
Maybe just one thing to add, just from the buyer's perspective, I think buyers have got a lot better at that kind of talent assimilation. I think if you go back 4 or 5 years, it was pretty rocky, but I think now everybody recognizes that in a lot of deals, right, the talent is really what you need. And so, how do we think about the integration of the talent, right? What do we think about role leveling, making people feel good about the new company that they're joining? All those things are really important. And I think a lot of corporate buyers have become a lot more savvy and just better at that, right? And the attrition therefore is much lower, which I think is really important.
That's right. Really good. We got a great tactical question that comes in. Virtual data rooms. There are many out there, many to choose from. Some have got AI tools that are embedded in them, some do not. Any thoughts on, like, does it matter at the end of the day which one's picked, or sort of considerations that go into making a good data room experience for both buy and sell side?
Yeah, I'll answer this in the first instance. So I think having a real data room is very helpful, right? So if you think that you're going to use whatever you've been using internally, so like Google Docs, for instance, or like that's not a great idea. There's some safety concerns there, but even if those have been dealt with, sorry, my cat is here. You end up, there's no way to have an index. There's no way to make it easy for a buyer, right? So I think if you start with the premise of let's make it as easy as possible, and I want to be as organized and efficient as possible, I think getting a real data room service provider that can offer an index, that offers all the abilities to know who's downloaded what and when, because if you have multiple bidders, things like that, you want to see how many people are in the data room, what are they actually looking at. All of that functionality. It's not cheap, but it's ultimately a pretty decent investment. A lot of them will work with you on fees and paying at the outset, not paying at the outset and paying at the end of a deal. So highly recommend doing something that is real. On the AI piece, I actually haven't seen that come into play too much. I think it could be useful if for a buyer perhaps, because if they want to analyze a bunch of contracts very quickly, but I don't know that we're there yet. So, and I think if they're going to rely on it, they're probably not relying on the data room to do it. They're going to rely on the tool that they have internally. So I'm not sure that I'm convinced by that analysis yet, but we'll see, maybe in the next year.
All right. Good intel. Thanks, Jackie. So speaking of tactical, here's another favorite topic du jour. Reps and warranty insurance, a necessary evil. Should I say that out loud? But what are we thinking for trend for 24? Any big impact that we're seeing on A&D deal market right now? Anyone can address? Anyone observed anything?
I can't really speak to the A&D deal market, but I can say generally, I think the RWI market is much more favorable than it was. So at the end of 2021, it was hard to get them to even do deals because they had sort of hit their quota of risk. And so the premiums were huge. And now we're back in the lower like twos on prices. So I think it's a good time if you want to do a deal and get it. They are more willing to work with you, and they're not as likely to in my experience, to carve things out. So I think it's a good market for rep and warranty insurance on the people getting insurance side.
Excellent.
Whether
We will
it's buy side or sell side. So
good. That's good. That's a good thing. Okay, we have a question coming in on SPACs, and just a curiosity on generally how they're being evaluated right now as a suitable M&A pursuit in the landscape today. Has anyone seen it as a viable strategy to go public, create liquidity for employees and existing investors, gaining access to broader financing sources? Any thoughts on SPACs as it relates to M&A?
I'm going to go 3 for 3 on questions. So I think they are still out there. I haven't seen one in probably well over a year, but I did see this question come through, so I wanted to look. There's one that I think happened today. It looks like investing platform Webull to go public through a SPAC deal. It got announced a few hours ago. It's not common. It requires essentially doing a pipe financing in a lot of cases, and there's not a great market. If the company is great, the feeling is probably it's not going to go public through a SPAC. There are exceptions to that, but yeah, so I wouldn't say it's a strong market for SPACs at all.
Very fair. Thanks, Jackie. All right, we are almost at time. So that means I get to try to squeeze either one more in or give you your key takeaway. You may take your choice on this. And this came in from one of our attendees today that wanted to know, what would you suggest founders not to do in the preparation of M&A? So maybe we can loop that in at the same time that I say, what's the one piece of advice you want to give to our founders today? So you can take it from either side of that, what not to do or what to do. Let's go round robin one last time. Amanda, starting with you.
Yeah, I guess a key take. We talked about the key takeaways a little bit earlier. I'd say one piece of advice that I advise sellers not to do is to take the first and only offer that comes to them. Maybe there's something in the timing of their lifetime events, the company, something that has happened that is maybe, I don't want to say forced the sale, but be prepared for that, being prepared to maybe evaluate multiple offers would allow you to know that you really did get the best. And sometimes it's not, we talked about earlier, it's not always about enterprise value and the multiple. There's so much more that goes into a deal, particularly when you think about the company you've built, the people that's helped you get there, and all the things that go into it. But I think, being disciplined about always thinking about what's the realm of possible, so that if and when something comes along that's very attractive, you have something by which you can compare and contrast it to. I think that also helps on the emotional aspect of walking away from the business you've built as well.
Really thoughtful. Thanks, Amanda.
Yep.
Jackie.
Sure. So again, I think it's pretty hard to summarize all this great information on this panel. I feel like I've learned things. So I think my key takeaway is that it kind of comes down to getting great advisors. So the folks on this panel, I think, I'm not just trying to plug us, but I do think that is really helpful. This is what we, do all the time and have done several times over. So I think that's really helpful. I'll also answer the second question, sort of what Amanda said, and I think others have said before, but don't get too, particularly on the sell side, don't get too aligned with a buyer. Even if you fall in love with the offer, you sign an LOI. If you start doing things that look like integrating, that could be a regulatory antitrust problem. But if you are like meeting them for dinner and you're going to their offsites or they're going to your offsites, it's a lot harder to negotiate terms that you don't like. And so you end up in not a great situation. So I think, keep your distance a little bit until the deal is actually closed. I think it's better for everyone.
Really helpful. Thank you. David.
Yeah, and I was going to go with the advisors part that Jackie mentioned too. I think, surround yourself with people that can give you good advice, right? And don't go it alone. I think there's lots of people out there who can help, protect your risk on the downside, right? And help you on the upside too. A lot of people think they know it all, which is really great. But there's lots of people out there who can help, who've done it, a couple of times as well. So that would be my one takeaway.
It takes a village in entrepreneurship. We're glad you're in the village. Melissa.
I would just say breathe and know that there should be the same level of energy, diligence, time, and patience that you provided yourself to start the business to sell the business.
Yeah, It is a part of the journey, not the end per se, at least not to start with. Well, I don't even know how I can summarize all the thanks that I feel I owe each and every one of you. And I know our founders feel that way and attendees today, but truly thank you for sharing these amazing insights on our M&A strategy for early to mid-stage entrepreneurs. Now, before we take our quick break, which I promised you at the start of this, we are going to be launching one last poll. If you are interested in following up with any of our amazing partners today, please do let us know. We'll be able to put you in touch. We'll make sure that they get your contact information. So go ahead and let us know, and we'll make sure those connections happen. We'll leave this one up and take good notes. And again, to our panel, thank you so much. We're going to take that 5-minute break, and we will be back in for our Aspen Institute fireside chat here momentarily. Thanks so much, and we'll see you soon. Hello and welcome back. It is wonderful to have you joining us today. If this is your first time joining, we're delighted to see you. We have a fireside chat that we are about to kick off with our very special guest from the Aspen Institute in just a moment. And then we're going to be going into our growth through acquisition strategy panel, so stay tuned for more. But first, please join me in welcoming our incredible special guest today, Vivian Schiller, VP and Executive Director of Aspen Digital at the Aspen Institute. Vivian, welcome. It is such a delight to have you here today.
Thank you. I'm thrilled to be here.
Lovely, lovely. Well, I would love to invite you maybe to start by sharing a little bit about your background and what you're most excited about in your role as VP and Executive Director of the Aspen Digital.
Yeah, thanks for having me, and thanks for letting me talk a little bit about the work I do and how I got here. I don't know how many of you are familiar with the Aspen Institute. It's a wonderful institution that looks at the impact of so many aspects of our lives on society and strives for a better world. The program that I run is called Aspen Digital, and we focus on technology and media and their impact on communities in just about every aspect of society. As you might imagine these days, it's all about AI, AI, AI. I've been with the Aspen Institute for about 4 years. Prior to that, I have a long career at the intersection of technology and news media. I have held executive positions at many news organizations. I was the president and CEO of NPR. I ran the New York Times website, nytimes.com. I was the global head of news for Twitter. So always about focused on how do we get reliable information into the hands of more people using technology, meeting people where they are, so that they have the information they need to participate in their communities. And that's what I'm all about. And I'm thrilled that I'm able to continue that work here now at Aspen.
And it is a timely time to have you here. So again, thank you for spending a little bit of your workday with us. We had a panel earlier where a lot of questions were coming inbound, just curious about how AI is really changing our world. And I think that is showing up ever more the case each and every day. A study by KPMG actually that we referenced earlier asked over 200 of the top business executives with more than $1 billion in revenue each year their views on generative AI. And obviously it continues to be seen, I think, as one of the top emerging technology trends out there. I'd love to maybe start by inviting your thoughts on how the Aspen Institute, broadly speaking, is thinking about AI relevant to the conversation here today, and also to, honestly, the advances of technology at large.
Yeah, thank you so much for asking me that question. I mean, what I feel like what we do best at my program at the Aspen Institute is sense making, and our sort of our sweet spot is big, complicated topics that have impact on a lot of people, and where we want to bring the public sector, the private sector, civil society together to try to solve problems. And AI fits that bill. I'm sure I don't need to tell anybody listening to this right now that AI has become sort of a bit of a gold rush and an arms race. And there is an extraordinary amount of hype. If somebody really who's not familiar with what AI is, and it means a lot of different things, and it means different things to different people, and its impact on every aspect of both business and society, you would be hard pressed to sort of find a place to get reliable information, because so much of it, again, so much hype. And I feel like the hype cycles fall into two categories. There's the oh my God, AI is the most amazing thing and it's going to solve every problem in the world. And if you're not just excited all the time, there's something wrong with you. And then on the other side is, oh my God, we're all going to die. AI is the worst thing to happen to humanity. Our robot overlords are going to take us over and it's going to lead to the extinction of humanity. And I fear sometimes there's not there's not a lot of space in the middle. I mean, both of those extremes, neither of those are an accurate representation of either where we are or where we're going. And so those are the kinds of things that we bring. I am pro tech. I'm a tech booster. I believe that tech can support our better angels and every aspect of our world, but we need to have our eyes wide open. And there's a lot of harms, and we need to know those harms, and we need to mitigate for those harms, and then we need to optimize for the good. So that's our approach. Happy to go into more detail, but that's kind of the 50,000-foot level.
It's so helpful. And it's interesting because the same report that we just referenced also noted that, a lot of business leaders are optimistic about the overall impact of generative AI. That's the plus. And if anything, I think there has been decrease, or at least this report referenced a decrease in the concerns over how this would affect their workforce.
Yeah.
But all that being said, I think there's still a lot of uncertainty, rightfully so, for business leaders in today as they think about what to adopt, what to embrace, where to put up guardrails. So what advice might you give to our founders, to our CEOs, to our entrepreneurs joining today, as they think about the role of generative AI as leaders in tech and leaders in this space, and what should they be thinking about and why?
Yeah, I'm so glad you asked me that. I mean, I would say number one, take a deep breath. You're going to get a lot of pressure it could be from your investors, from your boards, from all of your stakeholders, like, what are you doing in AI? And you want to approach this thoughtfully, and you want to understand it's not about just like superimposing AI onto whatever you're doing. I don't even know what that means. It's about thinking what your business purposes are and how can AI support what you're doing. There's a couple of things to keep in mind. First of all, you need to center the people that work for you. And whether they are, in sort of thought leadership positions, sort of, knowledge workers, or whether they are frontline workers, AI can both enhance their experiences. I think these sort of fears about job disruption, for the most part, are overblown. I think AI can make people's jobs better. It will not replace people's jobs, but it might take away some of the drudgery and make them more productive. But the absolute key thing is to involve your workforce in the decision making. You do not want to sort of unveil AI systems, particularly when it comes to frontline workers. For those of you that work with frontline workers, you want to involve them in the decision making. They know their jobs and their processes best. They want buy-in. They want those skills. And what we have seen in our research is that frontline workers and labor unions embrace AI if they are included in the conversation. And it can just be a win-win in terms of the efficiency and the optimization for the company and the well-being and the longevity and the retention of the workers. I would also think about how again, I know all different kinds of organizations are listening to this now, but if you have boards of directors or advisors or investors and your executive staff, to try to help get them as educated about AI as possible, not just broadly. And a lot of it is, what is the impact of AI going to have, on your customers, on all of your stakeholders, on their end users, and are you bringing to it a society oriented approach in thinking about the potential harms? This is and mitigating those harms. This is, I would like to believe that this is the right thing to do because it's just the right thing to do as people living on Earth. But it is also absolutely critical when it comes to protecting your company from any kind of liability or reputational harm. So education, there's all kinds of resources to brief boards, train your executives, involving your workers, taking a breath and experimenting in ways that do not have, unintended consequences.
I love that. And I'm so glad you shared a great outcome of involving workforce in decision making, because obviously that does remain still one of the concerns that exists around, is generative AI potentially risking professional development and advancement for the workforce at large, and certainly potentially causing decreased creativity and innovation as a result. So, how do you think about sort of encouraging C-suite private company that are joining today and beyond to think about the strategies and approaches that they can offer their workforce around these types of concerns, where the worry is generative AI could actually harm social interactions, increase unemployment, or create roles with really niche skills in that process?
Right. I would start as all processes must start with listening. Begin by asking your staff or the people who you think might be impacted, what are their concerns? What are they excited about? What are they worried about? And then as you were looking at, either in-house or third-party implementations of AI processes that can help optimize your work, bring representatives of the workforce into those conversations. They will have ideas because they do the work day in and day out that you just won't have. And think about how involving them in that process and implementing processes for them will, again, improve retention, improve recruiting, because word will get out, people talk, will improve your efficiency and the productivity in your workplace. And it's a win-win. There is no harm in having a council and involving them in every step of the way of involving, again, any kind of automated processes. There is no way you're going to, with rare exception, you're not going to be able to replace your workforce with AI, even if you want to. And so you want your team working with you, not against you.
Here's to working with you for sure. There's this wonderful quote that we were inspired by on Aspen Digital that references AI and cybersecurity are cross-cutting and truly global issues, and that the development of these governance principles and frameworks must also take into consideration local, historical, cultural, and political context. So I'm going to invite you maybe to share what are some frameworks, development of principles and frameworks that our late stage private companies could adopt today in their thinking around AI and cybersecurity, Vivian?
Yeah. Well, cybersecurity, I think I probably don't need to tell anybody on this call I'm actually glad that consciousness about the risks of cybersecurity are greater than they've ever been, so that people know how to take steps to protect themselves. Unfortunately, that consciousness is raised because there is an absolute epidemic of ransomware attacks and of hacking. But honestly, mostly it's ransomware attacks. There are so many tools and services, and I'm happy after the fact, Nicola, to share some of those resources that you can share with your community, share with this entire community, of steps that you can take to make sure, just simple steps that you can protect your organization. No organization is too small to take these kind of steps to protect your data and to protect and to sort of inoculate your staff and your teams from sort of phishing attacks and all other ways that the bad guys can get in. And there are many ways to protect yourself that are not that onerous, but really there is measurable. There is data-driven, data-based evidence to show that companies that take even these minimal steps are so much less prone to cyber attacks and ransomware attacks that can be absolutely devastating, if not existential for your company. And the thing about AI now is AI, like most things, it's two things can be true at the same time, as the great philosopher Taylor Swift likes to say, which is that AI can both enhance your cybersecurity protection. AI can also aid and abet the bad guys out there who can use ever more sophisticated ways to try to target your employees to reveal vulnerabilities. So it's just more and more important to protect yourself. And again, happy to share some of those resources.
That's fantastic. We will definitely take you up on that. Okay, I have one last question. And again, thank you so much for your time today. I want to go back to your roots as an incredible storyteller and a journalist. You know, we're in session today talking about the trends around current M&A market, but as companies do go to market to be bought, how might you frame the AI narrative into that story? And again, maybe what are some of those principles and values that they should consider in this?
I think it's important that you demonstrate that you're not just part of the hype cycle, that you're taking a really, I mean, first of all, this isn't just about telling the story. This is actually living the story, by the way, that you are not just responding because, you know, bringing in AI solutions because of those demands, that you're taking a very thoughtful approach about how AI can enhance your business, can enhance your bottom line, can enhance the quality of the goods and services or whatever it is that you are providing to the world, how it is enhancing the life of the communities that you serve. Again, we talked earlier about with reference to particularly vulnerable communities, and crucially how you are working hand in hand with your team, with your staff, with your workforce, with your vendors, whoever it is that you've got on AI. And I think that those, and how you're protecting yourself from cybersecurity risk. All of those things are elements of what make for a good story for both your investors and your customers and the public at large.
Fantastic. Vivian, thank you again so much for spending a few minutes with us today. It's been a treat, and thank you for the work that you're leading truly at Aspen Digital.
Thank you.
Cool to know you're out there doing that work, and we're all benefiting from that.
Great. So nice to be with you. Have a great rest of your day. Thanks, everybody. Bye.
All right. Now, before we begin our final panel, I've got one additional poll that I'm going to be rolling right now, and that is we want to know who is actually joining us for this session and how many acquisitions you're planning in the coming time over the next few months. So if you can just take a moment to let us know number of deal transactions, that will help our panelists really spend time on answering and providing information that can guide us through the remainder of time that we have today. Thank you so much. It's great to know we've got a large number of you sort of in the 1 to 3 mark and a handful in sort of the 3 to 5 and 5 to 10. So great representation here today. Thank you. Okay, now on to our last topic for today, growth through acquisition, the buy-side overview and insights panel. We have an amazing panel joined today. Our moderator is Rich Mullen, partner, mergers and acquisition at Wilson Sonsini. We have Andy Gersh joining, a partner at KPMG, Kyle Price, chief of staff and corporate development at Roblox, and Richard Mosher, VP Associate General Counsel as well at Roblox. Rich, thank you so much for being here, and I'm going to turn it over to you at this stage.
No, thank you. Hi, everybody. Great to get together. I'm really happy about the group we were able to organize for this panel. Andy and I have worked together a number of times over the past. He's been doing the accounting game for what, Andy, like 31 years, 32 years now, something like that?
I wish it was only 32 years, Rich. I think it's a little slightly longer than that, unfortunately.
So very
look here.
Very, very experienced on that front, and Kyle and Rich are my friends and clients, and we've done a number of M&A deals together. That'd be cool to get them together with you all today to kind of hear how they do M&A at Roblox and maybe some of their past experience, because Kyle was at eBay before that, and Rich has had a number of different jobs at some really great companies with some cool experience too. So. Anything you guys want to add on intro before we jump in? Good. I guess I should say something about myself too. So I'm, as mentioned, a partner in the M&A group, and I do a big range of different types of transactions, buy side, sell side, big deals, small deals. But a lot of it, is buy side stuff with companies like Roblox. So hoping to share some good thoughts today with you all. So one question to start for the group, as a lot of people know, the M&A market in 2023 was slower than it had been in the few years before that, which were, when you look historically, some of the busiest years in history. So tell us about your past year, 2023. What did you guys see happening? Any changes or trends? Kind of high-level thoughts on the past year.
Yeah, I guess I can go first. Internally, nothing really different. Like our business has been fortunate to be very healthy and chugging along. Our strategy really hasn't changed, so that's been great. Of course, the macro environment affects everything to some degree. So we've seen a bit more inbound activity. I think there's, depending on the stage and the financial profile of the company, there's been different pressures put on them that's made it a little bit more difficult, so resulting in a bit more inbound. Valuation expectations obviously have changed as a result of that. And then the final thing I'd mention is just from the view of a buy-side corporate is in order to warrant a premium for an acquisition, which costs money and takes time and has some additional risk, but of course, hopefully has some really great upside, there has to be a decent delta from your build path, right? So when you look at kind of a build by partner sort of thing. And I think that has gotten a bit smaller. A company like ours has been fortunate to continue hiring some great people. And so I think the requirements for us to be able to justify an acquisition and really warrant going through that process has been a little bit more difficult.
What about you, Andy?
Got it. So what was interesting about 23 was we saw somewhat of a shift in the sort of in the subsectors of deals. So we were seeing quite a lot of activity in semiconductors from sort of on the equipment side. Those guys were a little bit more active than we've seen them in the past. And it was just an interesting shift. They were sort of recognizing the benefit that was going to come off, let's say, the growth or the amazing performance of NVIDIA. Private equity, I wouldn't say went to sleep, but there was a lot more busted processes. There was a lot more hesitancy around sort of transacting, principally because of the declining valuations throughout the year, and also just some of the challenges in getting debt. We also saw, which has been a trend over the years, just a lot more shift to private capital. I'm not sure I can remember a deal from last year which had sort of bank, particularly in the middle market space, which had a lot of bank funding. It was very much the private capital folk coming into that sector. And then towards the end of the year, things just slowed significantly. So Q4 was pretty quiet for us on the technology side.
Rich, anything you want to add on 2020?
No, I think Kyle kind of nailed it. He's certainly on the front lines and sees a lot of the deal flow coming through his lens before it comes across my desk. And so, I don't think I have much to add from what Kyle shared.
Yeah, I would say when I look back at 2023, it was interesting. It felt like there was a lot of built up energy and people wanting to do stuff and waiting for market conditions to kind of land in the right spot. And that didn't quite happen for all the reasons Andy was kind of outlining. But Kyle, you guys actually did do a few deals over the past year, and under your leadership, you've built a pretty well-oiled M&A machine at Roblox now. So maybe could you give some insights on your approach to sourcing deals, evaluating transactions, and then ultimately completing deals?
Yeah, sure. Thanks. I don't know about well-oiled, but we certainly try, and there's always ways we can improve. So just for context, Roblox's M&A strategy is pretty straightforward. It's roadmap acceleration. We're looking for really great entrepreneurs, particularly engineers with some really cool technology that are vision aligned and that want to come join us, be a part of us, and build with us. So that typically takes the form of tech tuck-ins, typically early stage, not very big commercial operations, although a handful of them do have that to some degree. So that's kind of what we're up to. I think that strategy makes a lot of sense for a company like ours, which is, I'd like to think we're high growth. Of course, we could always be doing better, and we always aspire to be growing faster, but we're going pretty good, I'd say. And it's a particularly innovative company. So I think with those things combined, a roadmap acceleration focus for your corporate development team makes a lot of sense. As far as our approach to things, there's a few things I would call out. I'd say we're very iterative and agile. And what I mean by that is we've got a pretty broad product surface area and we've got a lot of technology. The company's been around a long time and has built most of its tech. So we spend a lot of time with our different product and engineering colleagues and groups. And we kind of on a regular basis stay close to what they're up to. And we ask them certain questions that we think draw out where an acquisition could make sense. And then we go out there in the market and we search for it. We get into kind of sourcing sprints. We try to move quickly and get to decisions as quickly as we can, and then move on from that. For us, two more things I'd point out. One, for us, I don't say it's all about the people, but it is all about the people. Of course, we evaluate tech and we attribute value to the technology, but it's really about what this group of people will do over the next multiple years when they're a part of Roblox. So we definitely spend a lot of time on that. And the other thing I'd say is our approach is generally, and Rich, you and others can please jump in because you have a broader market point of view on this, but I think we tend to put more focus on upfront work. And what I mean by that is we really get to know the individuals at the company, the founders, as much of the team as we can, depending on the deal dynamics. We really try to get to a good, solid thesis and a line point of view on what they would do, how it would work. We do collaborative brainstorming with them. And one, that just feels like the right thing to do, but two, I think that benefits us down the road when you get into execution, because at that point, there's not a lot of hidden things. Of course, there's always aspects that you haven't covered, and some of it you do find misaligned expectations, and you got to work through that at that point. But we definitely tend to spend more time up front, really getting to know the people, really making sure it's a strong cultural value fit. What they want to do is what we hope they will be able to do when they join here. And I think that really greases the wheels for us to have a generally pretty fast and pretty smooth execution and integration.
Yeah, I think that's right, Kyle. And for the audience, I think when Kyle's saying up front, he means before they ever put like a term sheet or an LOI in front of anybody or really talk about the business terms. And I think one of the things that does is it results in you guys having a lot of conviction in doing a deal when you get to the point of actually putting a term sheet in front of somebody. And when I look back on the deals we've done together, I feel like maybe all of them, save for one deal, once you put a term sheet out there, you end up completing the deal. And that's not the way every buyer operates. Some buyers will, put a term sheet out there, and then you guys do confirmatory diligence too, but do a lot of still business diligence confirming the deal thesis even after they've put the term sheet on the table. Anything you'd add to that, Andy?
Yeah, I'm seeing a lot more. I'm seeing a lot more busted deals these days when you put a term sheet out there, and I'm seeing it really in some of the complementary diligence. There's been in 2001, in 21 and 22, it was kind of like the go-go years and kind of the Wild West out here. And just as I'm seeing I'd say there was bad behavior by some sellers, which sort of investors were prepared to overlook. I think there's been a change now. I think if you put a term sheet out there, people are questioning, and people are going back and retrading and canceling it if they find that maybe the optimism or the hubris of some of the claims isn't quite met. Whereas 2 years ago, I rarely saw that happen.
Yeah, M&A it's a big team effort. When I talk to people that are coming up and wanting to do it, I explain a lot of the job is project management and coordinating people and understanding kind of human interactions. And Rich, I think you have a pretty unique background and perspective and add a lot of value. Given all that, you were general counsel at a couple companies that got sold. You were the head of corp dev at Ring, general counsel again at another company, and now kind of like you're a lawyer, but you also, I think, served a key business function on the M&A deals that we do. So maybe could you share your perspective on how an in-house lawyer like you can add value to the M&A process and help Kyle and his team and others?
Yeah, I think kind of to follow up on what Kyle was saying, I think the way I look at my job is want to make sure that we avoid surprises. So a lot of the effort that Kyle does on the front end, making sure that that confirms the investment thesis and with the acquisition, making sure there's good communication. So as part of the process, I do kind of more of the plumbing while Kyle's out talking with the team, but making sure that the internal groups are all coordinated so that when we have the ability to put a term sheet together, everybody's aware of what the transaction from the engineering team to the finance to the HR, and making sure that everybody's aligned. We do a nice job of setting up an M&A subcommittee. So we have kind of a group of core people that helps on the front end for the evaluation of the transaction, going through the diligence, and also helps when it comes to the integration on the back end. So I think that, Kyle and team have really done a nice job of kind of setting up the entire process so that when we do move to a term sheet, once we get to the term sheet, we're pretty confident in the deal, and we don't deviate from the term sheet. So when we go to DA and we start negotiating the agreements, we always can go back to the term sheet and said, this was laid out pretty clearly in the term sheet that we were going to do this. This was going to be how we were going to think about reps and warranties, indemnities, kind of all the more details that typically get negotiated a lot at the end. We do a lot of that on the front end. So it's worked out, I think, incredibly well. And especially compared to like prior experiences that I've had where we're not as aligned. The internal alignment is really a key to make sure that you can execute these deals efficiently.
Yeah, that maps up with what I was saying earlier. You guys have a lot of conviction, and I think it's a friendly way to do M&A to let a seller kind of negotiate a lot of the key stuff up front before they even go into exclusivity. But it kind of fits with your guys' personalities, and it a little bit biased, I guess, but I think it's been really successful. So, what are Rich, when you're working internally, what are some of like the key diligence issues that you have top of mind that are the risk areas you're looking into?
Yeah, I mean, as Kyle mentioned, a lot of it is we're looking at teams, we're looking at engineers. And so Roblox is a little bit different when it comes to the diligence. So the technical diligence is something that's important, but might not be as critical as doing the interviews that we have. So making sure that the engineers come in and it's going to be a good fit and that they're bringing the right experience. And so from a diligence perspective, our focus is a little bit different. But I think that one of the things that I bring to the table is just understanding the risk tolerance of the company. So as outside counsel, you're doing a lot of the diligence and you're going to be hyper conservative as you think about the issues and how they might impact the transaction. Whereas I can kind of help the company weigh those and determine whether or not it's something that we really is a third rail issue, or is it something that's nice to have. And then taking kind of the company's perspective and then rolling that back into the agreement. So do we need a special indemnity, for instance, on IP? Do we need some of those other considerations that we have? Do we need to have a founder revest to make sure that they're committed to the transaction long term? So there are lots of these things you come up during diligence, and I think that an in-house lawyer can help bring the analysis of that to help structure the transaction and to work as a liaison really between the outside counsel and the internal teams.
Andy, what about you? What kind of diligence issues are you seeing coming up in deals? What are the thorny stuff you've dealt with over the past year?
Yeah, there's been quite a few. It's been quite an eventful year. So the one that I'm seeing particularly around software companies is just the different definitions or interpretation of ARR, which is typically being used to value companies. And I would counsel anyone looking on the financial side just to make sort of certainly you're clear as to how they define it, and are you on a consistent basis, and then looking at the actual underlying calculations to make sure that they're not just fabricating some of the numbers. I've also seen some issues with just bad behavior by sellers, making up documents, making up bank statements. So just to the extent you've got maybe a proprietary deal, or it's not a sort of let's say a hot auction situation, just be thoughtful around the data that you're getting, and don't be fobbed off by the seller who claims it's too complex to obtain, or they don't want to provide it. To me, that's a kind of red flag if they're not willing to provide some some information in the process. The other thing I'm seeing is probably sort of in 21, 22, there was more domestic deals where I would see mostly, I'd say, a traditional working capital mechanism rather than a lockbox structure. There seemed to be a little bit more international transactions coming in, both inbound and outbound, and I'm seeing the number of lockbox structures tick up. I think that can sometimes be helpful for corporates when they're acquiring private companies and where they don't want to get into protracted discussion around working capital with the sellers. It's just provided the seller's not doing anything that's problematic, then it just makes a cleaner cutoff, albeit so you've got, and you can usually measure the risk. Slightly more of the risk lies with the buyer. The other situation I had this year is, and I haven't seen it for a few years, is just a very aggressive private equity buyer purchasing an asset from one of my clients, and just almost taking a scorched earth policy to trying to resolve the net working capital position. And at some point, you have to. They just didn't. The private equity buyer just didn't want to concede on anything, whereas the corporate, my corporate client, they just wanted to move on to the next. They've got to manage a business and they've got to execute. And they don't want to. Their business isn't to sit there and negotiate for months over a couple $1 million.
Yeah, and a lot of times for strategics, the strategic value of the deal is not necessarily, a few $1 million here and there in the financials and working capital. It's the stuff that Kyle and Rich were talking about, and that it's going to much outweigh, a few $1 million here and there. In case people aren't familiar with it, go ahead.
Sorry, I was just going to add one thing, and Andy's kind of touching on it, is just the importance of the kind of the tax diligence early on and kind of the way that you structure a deal, because it could have unintended consequences. And it seems like the tax code changes all the time as it comes to transactions. So making sure that you have good tax advisors, whether it's legal tax or outside tax, making sure that they're looking at the deal and helping you with the structure.
Yeah, that's a good point, Rich. And, Andy, why don't you take a minute and kind of explain all the different types of things KPMG can do? Because I think a lot of buy-side clients that maybe aren't used to engaging with a firm like yours underestimate the capabilities. So.
Yeah, thanks for that, Rich. And it's interesting. How we typically think of ourselves working is we'll sort of partner up with the law firms, and all our findings and our conclusions go two ways. They go to help the valuation for our clients, and they go to help sort of Wilson Sonsini figure out how the terms to include in the definitive agreement. So whether it's around HR or tax or some of the reps around financial. So we're what I see us helping, or where I see us helping our tech clients, is financial and accounting diligence, tax diligence. Occasionally be looking at the product itself to the extent it's an unusual platform that the client doesn't have. HR, IT for the back office systems, and then sometimes to the extent clients there's maybe confidentiality issues, will get involved in customer or vendor interviews and interviewing management about certain areas. There's a range of different services if it's kind of measurable, and then to the extent a client needs assistance in that space, and we can help. I think Rich raised an interesting point about tax diligence when clients are looking at or thinking about acquisitions. Historically, the seller would try to get value out of NOLs or out of some sort of tax step-up basis. There'd be a sharing of some of the benefits from the acquisition. I've seen a reduction in the number of those demands, but it's still important to make sure that you've got a long enough escrow that, and you're picking up the cost for any remediation. Often in small tech companies, you'll see issues around sales and use tax and state taxes, which just cost a lot of. It just is a bunch of time and money to get those resolved. So when you're negotiating in the escrow, make sure you try and get the seller to pay for that.
What do you mean sales? People don't have to pay sales taxes, right?
occasionally.
Kyle, let's go back to you and look back into time a little bit. When you did your first M&A deal, what's something you wish you knew then that you know now with all your experience?
Yeah, sure. I mean, there's two things. One's a bit more tactical, which is, I think, I think this takes reps to build your intuition around this, but I think it's if you can identify early on where you think there might be some misalignments on expectations, those are the things that are helpful to get out upfront and early on. And there's probably a proper sequencing that you should think through and importance and when you should be talking about different points. But I think there are things, I'll give an example of one that two that often come up for us at different times, which is title and reporting. You bring in some amazingly talented people who are CEOs and senior folks who have been running their company, and as part of a bigger company, they generally have a title and a reporting role that they maybe wouldn't have thought for their level or their experience, or at least what they've been up to recently. So that's sometimes a tough one to swallow. And so getting that out at the right time and early, I think, is really helpful. And again, I don't know that there's probably a handful that different people would list out, but I think some of it is pretty custom to the deal. There might be some aspects of it that you just pick up from different discussions and time together. That's why, again, I would emphasize time together. I mean, you think about the interview process that you do when you hire somebody and all the interviews and rounds they go through and different people they meet. I mean, I think you want something at least that comparable when you're getting to know somebody who's going to join your company through an acquisition. So that's one. And then the other one, which I think is a little bit harder, is to account for your bias. And I think we're all humans and we all have biases. And particularly as the people running the deals, you want to get the deals done. You're excited about it. Even if you're not gold on it or targeted, which we're not, you still get bias, right? As the process continues on. And if there's ways you can figure out how to kind of counteract that, or at least be aware of that, I think it's really helpful, right? And so the example there would be maybe you're hanging out with the founders and you're sensing something is not right, something's not a fit. There's some aspect of them that you're like, I'm not sure if they're gonna fit as a leader here because of this, but things are going well, and the product team really likes them and the technology is good, so let's just keep going. So I would just say to pay attention to those things and to account for your biases.
And Rich, what about when you look back? It was a baby
kind of
lawyer.
going back to the start. When my first transaction, I don't think I knew the difference between an asset purchase or a merger agreement or stock purchase. All those things. So when I kind of got thrown into it, it was trial by fire. But kind of looking back at it, what I wish I would have known more is kind of what we've implemented here at Roblox, is kind of spending as much time as you can early in the process to really get to know what the motivations are for the target. Understanding cap tables, I think, is another kind of thing that you really need to do from the beginning to make sure that you understand if the founders are going to get paid anything in the transaction. Are they going to be motivated? Are they going to be post-economic after the deal? So maybe they don't want to contribute. And what can you do to make sure that there's proper incentives going forward? So there's kind of lots of things, and as Kyle said, a lot of it you just have to do by reps. No deals are the same. Every deal has a little curveball that comes up, and it's different. So it's kind of the pattern recognition and kind of perspective that you can bring after doing them. However many deals you do, you just kind of, it's a muscle that you just have to keep exercising and getting better and better at.
So maybe a question for the group. Can you guys discuss how you think the lower PE activity over the past year and the private markets that Andy was mentioning earlier, that's the private debt markets. How do you think that's impacting M&A? Andy, from your perspective, broader, and then Kyle and Rich, more specific to a company like Roblox.
Yeah. I think I think from the corporate perspective, it's going to be positive. I think it's going to, we've seen a moderation in in valuations. There's less competition for assets. So corporate buyers who want to do some consolidation or expand have got maybe a little bit more flexibility, a bit more time to think about deals. We're starting to see sort of exits or PE exits from tech sort of companies, and this is across the range is down about 20%. I don't think that's sustainable. I think those funds have to churn their assets every, say typically 4 to 5 years. It could be longer, but there's in the next year or so, there's going to have to be a lot more sell side mandates, and we're beginning to see that. So you're going to have more assets on the available. I think in tech, I think the tech PE investors have been the most active in or most honest about the value of their portfolios. So they've, rather than keeping valuations high, as you'll see in maybe other sectors, they've kind of accepted the new dawn and sort of started to moderate positions. And interestingly, what we've seen is that rather than deals declining in Q4 of 23, they actually increased slightly from the prior quarter. So we think we've got to a stabilization period. I think some of it may be being driven by AI. There's just we're seeing a lot of investment and a lot of interest and activity in that space, and also just a slight moderation of interest rates, whether that can last or not, or whether it comes in and puts a sort of a break on the market is to be foreseen, but that also has helped.
Kyle, Rich, what do you guys think from a corporate buyer perspective? Are you seeing the PE markets and the debt markets affect you at all, or other corporates, your friends and colleagues, at other companies?
Yeah, I mean, Rich, defer to you a little bit on this one, but I mean, we play in our little bubble here of early stage startups doing quite specific things, kind of advanced tech. And so I think the knock-on effect is probably what I mentioned earlier, which is a bit more pressure on profitability, whether it's profitability or just slower cash burn, certainly. And as a result of that, unfortunately, some harder times for entrepreneurs, in which case they might reach out to us to consider other options.
So let's look ahead at the rest of the year. Any predictions for M&A over the next year, and any advice you might share with corporate buyers out there?
Rich, you want to? Oh, sorry. Go ahead, Andy.
No, I was going to say, you want to go?
I defer to Andy. I want to hear his thoughts.
So, where's my magic 8 ball or crystal ball here? We're seeing it's been slow the last it was slow at the end of January, beginning of February, but it's actually, activity seems to have increased quite a bit in the last couple of weeks. Across the US, our practices and our teams in New York are significantly busier than they were. So not quite at the 2021 level, but definitely ahead of 2023. As a firm, we're expecting some growth. We think it's tied to interest rates. If interest rates go up, I think the market will slow. We also think there'll be some slowdown towards the end of the summer, into the mid Q4, to see where the election cycle goes. I don't think it makes a significant difference which party wins, but I think just the uncertainty pre-election will cause some hesitancy about action. The interesting thing, we are seeing a lot more sell side activity from private equity. Just to come back to my earlier point, they need to exit some of the investments they may have made in 18 and 19, and we're seeing some demands from LPs to get money back before they'll put a new fund in. And as you're starting to get more maturity in the private equity fields, where junior partners or individuals who weren't partners in the older funds and now partners in the new funds, they're hungry to raise money and get rewarded for that. So we're moderately positive about the market. I think hopefully the sort of boom from AI, which I think there's a lot of hype in there. There's some real substance, but there's still a lot of hype. I don't think anyone really knows where AI is going. If that suddenly deflates, I think it'll have an impact on the broader market. But provided that sort of continues or just trends down slowly, then I think we'll see continued growth. And I think it's going to come through in the corporate side. I think the corporate buyers have been sitting on the sidelines for a couple of years, and they're going to start getting back in the market.
Great, thank you. We got a number of really good questions in the Q&A, so I think maybe now's a good time to pivot to that and finish up. Any particular way, Nicola? Any place you'd want to start?
Yeah, perfect, Rich. And to your point, what a great panel to set the stage for a lot of these questions that have been inspired by the thoughts you've been providing today. Let's try to hit a balance maybe of some of the strategic ones and the tactical ones that have come inbound. Maybe I'll go in reverse order. The last one that just came in is a really interesting one. Just getting this panel's thoughts on how sellers should prepare for different types of buyers, from PE firms to the mega corporates and corporates that may be more similar in size. Anyone want to sort of share recommendations for the differential stakeholders that some of our audience are considering as they go through this process?
As probably the only person here, well, maybe not the only person, but I've been on the sell side a number of times where my companies have been acquired. So I think the best thing you can do is be prepared. So almost do a diligence on your company. So in M&A, we always issue diligence out to the target. You probably want to do that with your own company, is just look at the diligence. These are the questions that people are likely to have, making sure you have all your corporate records, making sure you have your material agreements, making sure that these things are available. Virtual data rooms are great, so that if you do get into a process, you're able to kind of move quickly and have everything up, because it does take a lot of effort to identify all the documents, especially if your company's been around for a little while. You want to make sure that you have that as buttoned up as possible. It just also makes you look like you're more on top of your game when you're selling the company, when the diligence request comes over and you're able to respond quickly and have that information easily available.
Yeah, I think that's
Please go ahead, Rich.
incredibly important to be prepared. And to kind of tag along with that, I would say, think about who the buyer is, because everyone has their own personality and they're all going to care about different things, with more weight or less weight, depending on who they are. So like Kyle was saying earlier, a company like Roblox is going to be less worried about the financial profile of the business. Well, they got to look into that and the taxes and stuff. But the technology and the people and how you present the organization is going to be very important. If you're getting bought by a PE fund and they're thinking about the deal from a more financial perspective, you got to be able to modulate depending on who your audience is. So do some homework on the front end to try to get to know who you're going to be dealing with, and talking to good advisors or other founders that maybe have sold companies before, or people you might know at other corporates or PE funds can be helpful, give you good insights.
Very helpful. Thank you, Rich. Richard, can I come back to you just really quickly? There was a very important, I think, tactical question that had come in, really relating to the term sheet and questions on whether or not it's really binding or if it's non-binding. What are you sort of seeing around that? And whether or not the counterparty is good to go back and renegotiate certain terms like reps and warranties. Any insights that you can offer around that very important and somewhat unnerving point of the negotiations?
Yeah, I mean, so our term sheets are typically non-binding except for confidentiality provisions in the term sheets. But we do spend a lot of time, really making sure that we walk through it with when we present the term sheet, we have a call with the founders and their representatives and walk through the term sheet itself to identify all the different provisions, making sure that we call out that there's going to be a founder revest, for instance, that's included in there, that we have our standard reps and warranties are going to be included in the definitive agreement. So our term sheets are probably, I don't know, what do you think, Rich? Maybe like 3-4 pages, and they're somewhat high level, but they're detailed enough that it helps us when we're in the DA to go back and have that as kind of the touchstone of, we had this conversation, we talked to you about this, this is what we were identifying when we had this in the term sheet. We're not interested in retrading. But we also include in the term sheet, though, if there's something that comes up in diligence that's problematic or that we haven't seen, that we have the ability to go for a special escrow or other protections that we might need to address those issues that come up.
Yeah, the norm is, and the vast majority of the time, term sheets, LOIs, those things are non-binding, generally speaking, and there'll be some limited binding provisions like confidentiality that Rich mentioned, and then an exclusivity provision, whether that's in the LOI or the term sheet, or maybe set in a separate exclusivity agreement. And there might be a couple other binding provisions like governing law and things like that that you have in contracts, but the business terms are almost always not binding. And I would say sellers get comfortable with that, and buyers too, because people's reputation's on the line. If a company like Roblox or another big corporate is out signing term sheets all the time and then retrading terms, that's generally going to get out there in the market. And companies like this trade on their reputation, and they want to do deals over and over again. And if they're known in the market to be someone that you can't trust because they gave you a term sheet and then they retraded everything, then that's a bad look for them. That said, almost all these term sheets and LOIs are subject to due diligence, and you got to go. If you find an issue, usually people will find productive ways, constructive ways to address them. So,
excellent insights. Well, sometimes surprises can be wonderful things, but a lot of the times they can be a little unnerving. We had a great question that came in from one of our attendees today, asking for all of your reflections and sort of thinking about what surprised you in your history of experiencing M&A processes, and perhaps for the surprises that are not quite so good, what would you encourage those joining today to think about doing to avoid those types of unnerving surprises along the way? I'll open it up to the group to sort of share reflections on that.
Yeah, I guess maybe I can just share one thought that I have, and of course I'm very biased here, but I think the more authentic and straightforward people can be in these situations, the better. And of course, there's, I can empathize with startups and founders. I think there's a stereotype, or maybe actually truth here, that corporate development and deal professionals are professionals and they're negotiators and they know how to navigate this, and you got to be very careful what you say because they're going to use it against you and all that sort of stuff. And I'm sure that sort of stuff happens. So I wouldn't say, be naive to that fact. But I do think as things progress, the more upfront and direct you can be, again, you can still negotiate things, you can still have points and do that, but being authentic, I think, is really important. And I think those are the things that come across later as surprises, at least from my standpoint of, you eventually figure it out. I don't think many people are able to totally mask over some important things, even though they try to. So I would just encourage people, of course, do what's right for you and watch out for other actors. And I'm not saying everybody can be completely trusted and you have to be transparent from the beginning, but as you get that better feeling with a company and with some individuals, the more authentic you can be with them, the better.
Excellent. Andy?
Yeah, I think Kyle made a good point earlier. Trust your intuition. So if something doesn't feel right, then don't follow up, even if it seems a sort of a ridiculous intuition. Humans are typically pretty good at ferreting stuff out. I think the other thing to think about is, it's like when you make somebody a job offer. If they come back, they may be great in interviews, but you see the true colors of a person when they start negotiating over their package. And are they just greedy and looking for every last dollar? And it can be the same particularly with small private companies and startups. They may be getting a great offer, but do they suddenly want an extra $10 here, $3 there? And you start to get an insight into the character of an individual. So just be thoughtful about how they respond to an offer. If you're getting you've got a small startup and you're getting $100 million or whatever the number is, you've hit the lottery. That, you know, you start getting greedy over $1 or $2, then it's I always find it's quite insightful as to how they're going to behave post closing.
Yeah, I think along those lines too, a lot of times the seller might not appreciate the kind of ripple effects something like that has, because usually when you come to a term sheet, you're engaging your entire C-suite, you have your investment thesis, you've gone through all the financial analysis, and everybody's agreed to a certain package, and that's what in their minds, the deal is done kind of within those boundaries. So if it starts getting dragged out later on, you're gonna lose credibility if you're a seller, if you come back and retrade that. And there are a lot of people at the executive level that just might say, we're done, we're not going to deal with this, and just walk away. So I think back to Kyle's point, it's having that relationship and being authentic is really, really critical.
Very helpful. Thank you, Richard. When it comes to actually sourcing your deals, do you have any tools that any of you have used, or you've seen, other buy side use with regularity, and it's become a part of your toolbox, if you will?
Yeah, I can jump in on that. There's a bunch of desktop research ones. I mean, I think we primarily use PitchBook. There's CB Insights. There's a handful of others out there. And then there's a handful of startups that are trying to do it in more innovative, different ways, and they'll help you curate different lists like that. We don't use any of those, but I'm sure there's some great value in that. The only thing that I'd add on that is from a deal sourcing standpoint, similar to like when you're hiring an employee and you get a referral. Referrals are the best, highest quality. So I think there's internal and external for that. So depending on the size of your company and its maturity with acquisitions and corporate development, part of our role here, because we started the team 2.5, 3 years ago, after a company been around 15, 16 years with hardly any acquisitions. So part of our role is to kind of teach people what is M&A at Roblox, and how does it work, and how can they engage? Because you've got, subject matter experts who have lab partners and PhD friends and other people running companies all over, and they came from companies. So their network is incredibly valuable and powerful. And then same thing externally, depending on the stage of companies you're looking for. For us, it's a lot of early stage VCs. So I would say, in addition to your desktop-based, research-based sourcing tools, which are really good, I think the power of your network is really valuable too.
Really great insights. I love that internal recognition, investing internally to be able to source externally too. Great thoughts, Kyle. Thank you. Rich, we had a wonderful question come in that I was almost already going to tee up regarding the regulatory landscape. What are your thoughts right now on what you foresee in its evolution, and also learning curves relating to policymakers and legislators right now?
Regulatory is probably, at the top of the list of things deal makers are thinking about in today's environment, in particular antitrust, and then foreign direct investment laws, national security type stuff. And there's been a lot of agencies that have been exerting more authority and extending their reach over transactions than they had historically in the past. So, that's both the U.S. antitrust regulators, the CMA in the UK, some of the national security regimes across the globe are, adopting laws that are implicating transactions in ways that you wouldn't often expect. And even state regulators here in the United States have been inserting themselves in transactions and stuff like that too. So I think the broad takeaway is when you go into a deal, you have to really think about the regulatory risk and what that might mean for the transaction. It could mean, if it's a bigger transaction or you have to go through an intense regulatory process, it means deals could take longer. So be prepared for that. It's not uncommon now, if you have a deal, you think there's going to be an antitrust investigation that could go out for 2 years, 15 months, 2 years, 18 months, something like that. And together with that, sellers are, like in every deal, are expecting certainty to closing the transaction. So what does that mean? Buyers they're going to have to make some commitments around covenants, agreements that they'll do certain things to get the deal closed. Or if a deal gets blocked, will they pay a termination fee to the seller for being stuck in the deal and not being able to get it completed? Those things are getting negotiated a lot more. They were negotiated in the past where there was risky deals and we all were expecting it. And now there's just more transactions that have a question mark on them, and whether or not we'll have to go through a regulatory process, and sellers are putting more emphasis on those. So when you look at the data, we're seeing those types of provisions becoming more common in transactions. And then on the front end, people are planning for this stuff, like I was saying, not just in the deal terms and it potentially taking longer, but doing an advanced steps to actually fix the problem before the regulators even look at it. So you might, for example, line up a divestiture of an asset, that a portion of a business that you think the government might find there to be risk around, so that you can go into the government in advance, right after you announce the deal, and say, look, we're expecting you might be worried about XYZ things, so we've already solved it for you. And you don't have to be worried about that. It's a path that some deals have been taking. So some companies are I've talked to some buyers that have decided they don't want to do deals for a year or more because they don't want to go through the regulatory scrutiny. So there's also some that are sitting on the sidelines right now.
I think it's also important on the seller side that you're thinking about what documents you might have to produce, especially in the antitrust perspective, like the 4C documents. If you kind of tip over into that category, are going to be looked at, very closely by the regulators. And you want to make sure that you don't have any language in there that's talking about price protection or any sort of other antitrust buzzwords that they're using to justify the transaction.
It's a really great point, and it's the buy side too. It's not just sell side.
Yeah, exactly, both sides.
And people, Rich and I actually lived through a really intense antitrust deal several years ago when we sold a company. He was a GCF called iControl, and people are often shocked at the authority and powers that the government have in these situations. I mean, they will send you what is effectively a subpoena. That can request an incredibly broad scope of documents. So, managing what you write down and having conversations about stuff are better ways to, manage the process and try to minimize regulatory risk.
The increased cost, if you get into a regulatory investigation, I mean, the cost of the transaction, you'll add tens of millions of dollars to the transaction just from the legal fees. And so anything you can do to avoid that is always better to think about that on the front end than get stuck with it later on.
I'll consider ourselves forewarned on that. Thank you both for those insights, as scary as they may be. I'm going to try to squeeze in one more before we go into sort of final key takeaways, if we can. Our time has flown today. And it's a round robin one, again, to the extent that anyone wants to share their perspectives. To what degree are you thinking about ESG as a consideration today in the transactions that you're either participating in, observing, advising around? And if so, how do you diligence? What is the diligence considerations in data verification, including supply chain as well as reporting processes? Anyone want to sort of share what you're seeing as far as that side of things right now?
I think I know the European Union is focused on ESG. I think its prominence in the US market is declining. I think if there's a Republican administration, there'll be a push for it to decline even further and faster. And I think you'll still see some funds claim they're sort of ESG related or focused, but I think the number is diminishing. In terms of doing diligence on it, it's still, there's so much variation. And rather than narrative, people are looking for statistics around what companies are doing. I think from a practical perspective, companies don't want to pollute. They want to look after their employees and they want to save money and so most companies try to do the right thing from a, let's say, an environmental, social, and governance perspective anyway.
Yeah, Andy's probably right. I feel like ESG has lost a little bit of traction in the US markets from where it was a little while back. But that said, the corporates in particular have their own brands and personalities that they put out into the world. And when they go do deals, they do think about whether or not a target's profile, whether it's ESG or however you want to characterize it, could impact how they might get perceived if they buy that company. So just as an example, a year or so ago, I had a deal fall apart because the buyer didn't love how the target had handled certain, sexual discrimination allegations and things like that internally, and how they just were treating women generally at the company. Not something they were expecting when they went in and started doing the diligence, but they found some things that they've said, this is just not, we like the deal, the business and that kind of stuff, but it just doesn't make sense to take on that potential risk. So.
Well, thank you all. I'm going to ask the last fun question that we get to today, and that is, can you give us just one more great piece of advice for our attendees to walk away with today in whatever you're inspired to do so? Let's start, Kyle, and then I'll go to Richard, Andy, and Rich, I'll invite you to close this up. So Kyle, one piece of advice, if you will.
Yeah, I guess I'm sure the audience is diverse out there in backgrounds and what they're into. I think I would maybe just share a message to startup founders and entrepreneurs out there. And I just echo what I said before. Again, of course, you've got to navigate these processes in the way that are best for you. The more you can build a trusted relationship, be authentic, be upfront, and have somebody that you feel like you can be comfortable being upfront with, I think the better it's going to be. And maybe one sub bullet to that is on one of the earlier questions is getting prepared for acquisitions. I think being able to clearly articulate what it is that you and your founding team and your employees want to do next. You might have a bit of a thesis of why X company and Roblox make sense. You're not going to know the inner workings of Roblox, so it'll be difficult for you to really nail that down. But having a hypothesis is really good. But also just being clear on what it is you want to do and what you don't want to do. I think that's one of the things we quickly get to just make sure there's alignment in what we hope that team will be able to do. And unfortunately, we do chat with a handful of people that they're just not clear on what that is yet. And that's certainly a question for us.
Thank you, Kyle. Richard.
Yeah, I think it's important to develop internal and external teams. So making sure that you have alignment cross-functionally for the groups that you're going to have IT, you're going to have HR, you're going to have finance, making sure that you have kind of a M&A committee within the company so that you're able to help and analyze deals quickly. Then it's also important to have really good external counsel and financial advisors that you use. And kind of the more deals that you do with the same teams, you kind of develop. And I've worked with Rich now for 15 plus years or so. And just having that cadence and having that understanding, it makes the deals much more efficient. Kind of how the other person's going to think. And it makes it so that you can have a really efficient process.
Andy.
Be thoughtful about using earnouts. They're kind of creeping back into the market and seldom met and always paid. And do you really want to get into a debate about why your employees haven't met their targets, so you're not going to pay the earnout?
Very critical. Came up earlier on our other side of the panel too, Andy. Thank you for that reminder. Rich, round us out.
I'm dealing with an earnout potential litigation right now. Those are not fun. I would say for buy-side clients, develop a good, thoughtful process and spend some time in advance before you even go try to do a deal to develop, what your process is going to look like, what your form LOIs are going to look like, what your confidentiality agreement is going to look like, and try to have a system that you can use and execute on and refine as you go over time. Because once you get into a deal, it's a big time sink. There's a lot of energy and tension sometimes. So to the extent you can do some planning on the front end, it will make all that go a lot more smoothly.
Amazing. Thank you. Well, I know we didn't get to everyone's great questions today, but I do have good news. I'm going to launch one last poll for you. So if you didn't get to ask the question to our experts, you can still request to meet with them. So this poll is going to help us connect you in to our amazing panelists who joined today. So please take a moment to let us know if you would like to connect with any of them, and we'll make sure we get your contact information over to them for follow-up meetings. To our panel, thank you so much. As I'm sure you've seen in chat, just a deep appreciation and gratitude today for all of the findings and insights and the information that you shared. We really appreciate you taking the time to connect with us and really walk through a lot of complex scenarios and give everyone more confidence in how they handle this and this market and this time. Thank you all for joining us today. It has been a wonderful few hours spent together. We really appreciate you and our community at large, and we will look forward to welcoming you back to our next program very soon. Have a great day ahead.